All right, and good morning, everyone. Welcome to the ValueCharts Active Trader Series. We have a great lineup today. First up, we're going to have David Drew Day from Microquant. Then we're going to have Andrew Keene, Brad Powell, Bennett McDowell, and Dwayne Gott all throughout the day. So first off, I want to introduce myself. My name is Thomas Wood. I'm the Director of Trading Operations here at Microquant. I'm also the manager of the Futures Live Trading Room. And I'm going to go ahead and introduce our first speaker, which is David Drew Day. He's the co-founder of Microquant and ValueCharts.com. Today he's going to be talking about unlocking the mysteries of candlestick trading. He's been in the hedge fund industry for many years. He's been a guest speaker at several different major events all around the world for Bloomberg and various other top-notch financial firms. So Drew, go ahead and take it away.
Well, thank you, Thomas. Good morning, everybody. I appreciate your attendance this morning. Can everybody hear me? Let's see here. There might be a little bit of a lag in my line, but everyone can hear me? All right, just fine. Thank you, Guy. Very good. Thank you, Arthur. All right, let's go ahead and get started. Before we get into the basic overview of unlocking the mystery of candlestick charting, I want to give you a little bit more of a background about me. I have 12 years of experience in the hedge fund industry. Started about 12 years ago in Naples, Florida for a boutique investment manager. My first job was to get them ready for a regulatory audit. It took me about 3 weeks at 100 hours a week to get them ready, and it was a phenomenal experience. And so as I started in the hedge fund industry, I didn't think that I would get into trading, but as with most hedge funds, there's a natural progression where you start off as an intern and you find yourself migrating more and more towards trading the markets. And so that's exactly what happened with me. I started, and there's about 3 legs of a hedge fund. Any type of hedge fund strategy you have, there's compliance and operations as one leg, marketing and sales is another, and then the core backbone would be trading and research. And so I've had experience in all 3 of those areas. I have so much that I've lived in both the United States and the Cayman Islands. I was involved in structuring an offshore master feeder structure, working internationally, and have served as an advisor or director to several different hedge funds that have all raised and managed over $1 billion in assets under management. I am, as Thomas said, a co-founder of ValueCharts.com, Microquant, and SmartSetups.com. I am registered. I have a Series 3 and 30, and I'm also a certified hedge fund professional. I reside in the Dallas-Fort Worth area, just a little bit north of Dallas, with my wife, Sarah, and my 6-month-old daughter, Stella. So if I yawn today, I apologize. I just don't get much sleep these days. And if it's not me, some of the professionals I work with, Thomas, Mark, Hubert Centers, some others, we've all been featured in some of these publications, but that really doesn't matter. You just want to learn how to trade today. So let me give you just a basic risk disclosure because I am registered, and then we'll get into the meat of the presentation. So trading or investing carries a high degree of risk, and it's not suitable for everybody. If you can't afford to lose in your trading, then you shouldn't trade. And past performance is not indicative of future results. So as you go into this massively complex universe of trading, no matter what market it is, you've got to be willing to take on risk. And if you can't afford to lose the capital, don't get into it. So if anybody tells you that their strategies or their tools are going to help you always make money, you better run, because that's not the truth. Losing is part of the trading game. We don't have any hypotheticals today, so we can pass that and get on with it. So we started Microquant, ValueCharts.com, and SmartSetups.com with this core goal in mind, to help traders develop a proper framework for trading. There's a lot of people that go into trading unarmed with all the information, and we have a strong bent towards technical analysis. Most hedge funds do, that I've worked with. And when I look at candlestick charting and I look at technical analysis, they go together like peanut butter and jelly. They're a perfect fit for one another. And in today's presentation, we're just going to go through a very basic overview of two bullish patterns and two bearish patterns that occur quite frequently, and you can make really good trading decisions by having just a basic overview and understanding of candlesticks. Steve Nissen says that candlesticks are not designed to be a complete system. They're just one weapon, although a powerful one, to use in your trading battles. Some of the benefits of candlestick charting are that it's very easy to understand. You can identify earlier indication of market turns. They provide unique market insight. They're fun to learn. They're easy to learn. Once you learn them, these charting patterns can be exceptionally powerful in your trading battles. They complement other chart analysis and increase the efficiency of your analysis. Candlestick charting has been around since the 17th century in Japan from a prominent rice trader named Munhisha Hama. He's known as the god of the markets, and there he was started trading in 1724, or excuse me, was born in 1724 all the way through 1803, and developed this very powerful visual trading strategy. So let's look at the basic construction of a candlestick. Here, it doesn't really matter if the candlestick's green or red. There's a few things that I'm going to point out to you here. Every candlestick should have an open, high, low close, a real body, and an upper shadow and a lower shadow. These upper and lower shadows can also be called wicks, and these are the core components of all candlesticks. Here's an example on the left of a bullish candlestick pattern. We can see, looking at the open, high, low close, the market opens lower and closes higher. So this would indicate that the market is a bullish market. Over here, we see the open is higher and the close is lower. So this would be a bearish candlestick pattern. What I'm going to do today is I'll walk you through these four basic candlestick patterns. They're kind of the fundamental building blocks of candlestick charting. The first is the hammer candlestick pattern. This is a bullish pattern, and you can use it in your reversal patterns to create great setups for going long. And there's some basic requirements for a hammer. The real body has to be at the upper end of a trading range, excuse me, the lower range of a lower end of a trading range. The color of the real body doesn't really matter whether it's green or red. But one thing that is important with a hammer is that the long lower shadow or wick, this kind of green line and this red line here, needs to be at least 2 times the real body. The hammer typically occurs after a price decline or even a short decline, and no confirmation is needed with a hammer. Again, Steve Nissen says, in my experience, the success of the hammer does not depend on the color of the real body. I'm just going to walk you through a few basic examples. So here is an example of a hammer. You've got the real body, and typically with a hammer, we don't like to see much of a wick. No wick is preferred, but sometimes a little shadow, upper shadow, or a wick is okay. The important part is that the body is 2 times, or the wick is 2 times that of the body to qualify. Now, here we can see that this market is in a downtrend, and we have a perfect hammer at the very bottom. This long lower shadow or wick communicates that the market sold off sharply in the session and then rallied back at the close. Hammers should be preceded by downtrends, and these downtrends can be either minor or major downtrends. All right, again, here's another example with a lower shadow or wick being twice that of the body. And now let's go through a few just hammer checks just to see. Is this a hammer? Absolutely. Red candles are fine. The lower shadow just needs to be 2 times the body. I'm just going to drill that home before we look at some examples of some charts. Is this a hammer? No. The lower shadow is not twice the length of the body. Is this a hammer? No, the body is not at the top of the range. Now, a little bit of a wick is okay. This right here is probably a little bit too much of a wick or upper shadow, so I would not qualify that kind of pattern as a hammer. Now, this one right here is definitely a hammer, even though it has a small wick at the top. That's fine. Here's some examples. We can see that the market has sold off sharply, and then we have a perfect hammer, which indicates, hey, this is a good opportunity for me to go long. Now, typically what we like to educate people on when they're trading, and a lot of the hedge funds I've worked with, they'll look for a hammer that's preceded by this downtrend to go long, and they'll combine other technicals, different types of indicators as confirmation. And one strategy that I've used that's been very successful is using the hammer candlestick pattern to set up an opportunity to go long, but then I'll also use some kind of momentum indicator or a parabolic SAR or an MQ trend indicator that gives me a confirmation that I'm making the right decision. And then we can see another decline and then a perfect hammer, and you can see these are great opportunities to go long. This is just the same graph, just all the colors are blacked out, so you can see how those hammers function. Here's another interesting pattern where the market's actually climbing, and then we have a little sell-off here and a nice hammer to go long. Same thing. Here's an example of a failed hammer. Sometimes these candlestick patterns can be extremely valuable in your chart analysis, but sometimes they don't work. That's why it's important to use candles with other types of technical analysis that you're comfortable with to avoid unattractive trading opportunities. So on the first part of this graph, we can see that the market's sold off. We've got a nice little hammer almost. Sometimes you can go ahead and move forward with these candles, even though they're not 100% of a hammer. So this one right here, the body's not twice the wick, but in this case it actually worked. So if I had other charting analysis up and I was analyzing the market, I might be able to go ahead and go long even though the candle's not 100% confirmed. Then we have an example of the market selling off, and we have a failed hammer. And this is just the case in point that don't just use the candlestick hammer pattern for going long. Have some kind of filter, have some kind of confirmation or checks and balances in place to prevent you from going into an unattractive trade. Here's a great hammer example right at the bottom of the market, excuse me. Good opportunity to go long. And another example. I'm going to show you some charts. This is some recent charts we were looking at here. This is Apple on a daily basis, and we can see several opportunities. So the market sell off, and here's a perfect hammer. We could go long for a brief time, and this is one question that's asked quite frequently is, well, you know, what's kind of the best time frame for using these candlesticks? And my personal preference is to use them on a weekly basis, but you can use them on a daily basis and capture nice profits. The market sells off again. We have a perfect hammer, and but you can see right here these little jumps are great, but then there's a huge sell-off, and this is where you do want to look at for some other shorting strategies. Of course, hammers are more bullish reversal patterns, so you can see two opportunities to make a quick profit, but then we see this huge sell-off, and it's preceded, or it's followed by a perfect hammer. So this one right here is the hammer that I would definitely be looking to use, as we have a nice sharp price decline, where we could go long. Looking at crude oil on a daily basis, we've got some choppiness going on in the market, and here we have a little bit of a price decline, and there's a hammer. This one right here is an interesting one because I've circled it in red because this is really almost like a hanging man, which we'll get to in a few minutes. Really, I like to see hanging mans at the very top of the market, but this is almost, you could qualify as a hanging man, or possibly sometimes I call them inverted hammers, and that'd be a good short right there. And then we have this continual decline, and here's two hammers in a row. So this is really where you want to use a hammer pattern. You've got a nice decline in price, and if you see two in a row, that's almost a surefire way for you to go ahead and take a long position. It's a good opportunity to be there. And let's look at Google here on a daily basis. We've got a nice run up, and then we've got a nice price decline here. And here's this would qualify as a hammer. It kind of looks a little bit like a doji, but I would actually qualify that as a hammer, preceded by the nice sharp decline in price. Good opportunity for us to go long. Google on a weekly basis here is a great opportunity. My personal preference for trading with candlestick patterns is to look at a weekly chart. And you can see the market sold off again, and we've got a nice hammer preceded by this decline, which indicates let's go long. Now, I want to show you a few things in this weekly graph because I think there's some good opportunity here for us to consider. So we've looked at several examples of hammers throughout the day already, but let's take a look here at maybe some failed hammers or some different opportunity. Right here at the very top of the market, we have what almost qualifies as a inverted hammer, and there's differing views on this, but I like to go a little bit against the grain sometimes. And when I see this kind of pattern right here, I typically short that. And it's worked out favorably for me in some of my trades. Sometimes it doesn't, but I like to take the risk. And a lot of the hedge funds I've worked with have actually taken risk using this kind of strategy that's almost like an inverted hammer to short the market. Of course, they combine that with a few other tools, but when I see a big move and then I see almost this engulfing pattern here where this second price bar actually engulfs the body almost of this inverted hammer, I would definitely look to go short in that situation. So you could short that, and then here's your hammer to go long. Here's another example of that kind of inverted hammer. That's what I like to call those. And it's not truly engulfed, but you've got two negative price bars. And when I see this kind of volume and a price bar preceding this kind of candlestick, I typically go short. So there's two examples of where you could go short in the market. Now there's a nice hammer as well. So you've got a nice sell-off. So you can see on a weekly basis and even on a daily basis, you've got several opportunities to both go long and short in using candlesticks. That's the hammer. Let's get on into the hanging man. The hanging man candlestick pattern is it's kind of the opposite of the hammer. It's a bearish pattern, and some of the requirements is the real body has got to be at the upper end of a trading range. The color of the real body, not important. The long lower shadow or wick needs to be twice that of the body. There's no upper shadow or a very short shadow or wick at the very top. The hanging man has to occur after a price rally, preferably at the all-time high. The confirmation is needed with the falling price bar closing below the real body of the hanging man. So for example, here we have a hanging man preceded by a sharp rally, and then this next price bar actually closes below the body of the hanging man. Same in this case. Oops. All right, there we go. Hanging man candlestick pattern. It's, again, the confusing part about the hanging man and the hammer is that they look identical, but it's really where they're placed on the chart, whether they're after a sharp price decline or a rally. And after a rally, you would consider it a hanging man. So the rules are the same. The lower shadow must be at least twice the height of the body to qualify as a hanging man. And again, just to communicate the point here, we've got a nice rally, then a perfect hanging man, and this long wick or lower shadow communicates that the market sold off sharply in a session and then rallied back at the close. And then to confirm that this is a good opportunity to go short, this next price bar has to close below the candle real body. So that's an interesting concept there. Very simple, very straightforward, surprisingly straightforward for trading. Here's a hanging man pattern. Should be, again, preceded by a significant uptrend. I would also say that you could go over some minor uptrends as well and use a hanging man for some shorter term profits. It's just strengthen when you have a more significant uptrend. Again, the lower shadow must be at least twice that of the body to qualify as a hanging man. Here's another good example of a nice price rally, and that's a perfect hanging man pattern. We can see the confirmation here, and we would go short. Interesting, if you look at this little graph here, there's several different hammers and candlesticks throughout. This could qualify as a hammer here. This could be kind of an inverted hammer. And let's see, where else? Got a nice little double hammer pattern there. But again, these are failed hammers because the market tends to sell off. Hanging man, you're going to short. Hammers, you're going to go long. Let's take a look at some examples here. We're on Google looking at a daily chart going back into August time frame. You can see the market is having a nice uptrend here, and there was a perfect hanging man example, and you can see that'd be a great shorting opportunity. And here's an interesting thing. So sometimes when we're trading the market and we see these big uptrends and we're looking to get into a trade, whether we're at work or I talk to a lot of traders, and some of them just aren't always able to be right in the market, but they're interested in a trade setup. Well, if you miss the first hammer after a price rally, don't worry about that, because sometimes and oftentimes you'll see some confirmations along the way. So we can see this market begins to sell off. Well, here's another hammer. And so you could go long there as well. Excuse me, go short there as well. It's just confirmation that the market's going to continue to decline. You've got the decline, decline, decline. We expect to see some hammers in this shorting pattern. And let's see here. What else do we have in this chart? Here's another example of a failed hanging man. I'm trying to show you examples of both positive examples and negative examples so that you can have a very good understanding of what works and what doesn't. You've got to combine this with technicals in order to really make more effective trading decisions. But for beginners, this is a great opportunity right here to go short. Right here, this is a failed confirmation because you can see this second price bar here actually closes above the hanging man. So you would definitely avoid going short there. All right, here's another example. Again, I like to use candles on a weekly basis. And in this case, the market has rallied up, and there's a perfect hanging man right there. We've got nice confirmation with the second price bar that's closing below the real body of the hanging man, which is a great indication for us to go short here. And let's see here. Just to digress for a second, let's look at this chart and look at for some other examples. You can see the market sells off here, preceded by a downtrend. This is a perfect hammer. Good opportunity to go long. And it's about all I'm seeing right here that makes sense. And another Google example of a hanging man. We've got a nice strong rally. And then we have a hanging man. Now here's an interesting thing. So we see the hanging man, but this second price bar is not confirming for us to go short because it's closing higher than the real body of the hanging man. That's okay. Typically what you do in this situation is you wait until you see the next price bar start to decline. And so since this price bar shows more heavy volume and starts to sell off and closes lower than the hanging man, this is where I would look to go short. And that's a great opportunity. And here we go. This is a interesting hammer. It's kind of inverted hammer following that price decline. So you can see how you can use this both ways. That's the difference between the hanging man and the hammer. The hammer is your bullish pattern where you look for long-term or longer setups to go long, and the hanging man is what you use to look for shorting setups. Let's get into bullish engulfing. The bullish engulfing candlestick pattern is, it says it in the name, very self-explanatory and very easy to understand. If you know nothing about trading or technical analysis, the bullish engulfing pattern is probably one of the, in my opinion, one of the easiest strategies for you to start getting your feet wet in trading. And so if you look at this market here, remember, with candlesticks, typically when you're looking to go long, you're going to be followed by this significant or minor downtrend. And in this case, we can see that this bull candle, the body, actually engulfs the body of the bear candle. So we're right at the end of this downtrend, and this green bull, just the body, not the wicks. You don't care about those in a bullish engulfing pattern. But it's got to engulf the bearish candle, and that's a great indication for us to look at a reversal pattern and go long. So some of the requirements for bearish engulf, I've got a typo there. Let's see here. Yeah, that should say bullish engulfing requirements. I apologize. I'll blame that on lack of sleep. But the bear candle is followed by a larger engulfing bull candle. It must come after a clearly defined downtrend. The heavy volume in the bull candle actually strengthens this pattern. The bull candle need not engulf the bear candle shadows or wicks, as I previously mentioned. And the first candle in this pattern could be a doji, which we explain more thoroughly in our live trading room. And no confirmation is needed with the bullish engulfing pattern. Here's another example where the bull candle must engulf the bear candle entirely, just the body. The wicks don't matter in this pattern. So this is a great example. Here, there's another typo. I apologize again. This should say downtrend, not uptrend. So a bullish engulfing pattern should be preceded by a significant downtrend. Ignore that uptrend right there. This pattern is strengthened by heavy volume on the second candle. Here's a great example of a bullish engulfing pattern. There's typos all over this, but ignore that. Right here, actually this is not a typo, so I rescind that statement. Okay, so in this case right here, we've got an uptrend, and then we have a bear candle engulfing a bull. And so this would be a good opportunity to short. So this is our example of bearish engulfing. Then we have a nice downtrend, and we have a bull engulfing a bear candle, which is a great indication for us to go long. Another example of our bullish engulfing, preceded by the downtrend. The bull engulfs the bear. Let's go long. Look at a few examples here. I like to trade Forex. The euro is a favorite market of mine. There's lots of volatility in the Forex space, which I enjoy, especially some of the hedge funds I work with like to trade in the Forex market, and it's a great market to trade. Here's the euro, and we're looking at several opportunities here. This is a great example of a bullish engulfing. So the market continues to sell off. This is back in July timeframe, early July. Got a nice sell-off, and this bull totally engulfs the bear. You can miss out sometimes on these when there's heavy volume here, but when I would see that in the middle of a session, I would probably be looking to go long as I see this market selling off, getting kind of closer to a bottom. A great opportunity for us to go long. And that's a bullish engulfing pattern on a daily Forex on the euro. Trying to look for some other opportunities in this market here. This right here would be kind of a little bit of a bearish engulfing pattern. You can see the bear engulfing the bull, and that's about all I'm seeing. There's another bearish engulfing pattern right there. Strong volume there, and the bear candle engulfing the bull. But let's move on to another example. Let's see, a few months before, this is in June. I see we've got this nice little downtrend, and we have a bull engulfing a bear. Good opportunity to go long. And we can use, the nice part about using bullish and bearish engulfing is that you can use them to offset each other. So we could go long here, and then when we see this bearish engulfing, with this bear engulfing the real body of the bull candle, we could go short. So you can use it as a nice filter. And sometimes I just use the bullish and bearish engulfing pattern, very simple, and that's all I'm using sometimes to make trading decisions. I like to keep things simple. Sometimes I think we can make things very complicated by throwing way too many tools on a chart, and it can become more congested and harder to read. But in this case, with a bullish and bearish engulfing pattern, case in point, you can use this, and it works exceptionally well in your trading decisions. So let's see what else we have here. Here's Google on a weekly, bullish engulfing. You can see the market's sold off. It's got a nice sell-off here, and this bull totally engulfs the bear, and that's a great opportunity to go long. And let's see what else we have in this chart. Let's see if I can point out a few things for you. I don't really see too much as far as bullish and bearish engulfing besides this nice move right here. Right here, this would be more of a bearish engulfing pattern. You see the bear engulfing the body of the bull candle. Bearish engulfing candlestick pattern. This is obviously where we look at a reversal, and it's the complete opposite of the bullish engulfing. In this case, the bull candle is followed by a larger engulfing bear candle. So our bear is going to engulf the bull. Now keep in mind that the wicks do not matter in the engulfing patterns. The bearish engulfing must come after a clearly defined uptrend, and heavy volume in the bear candle strengthens this pattern. The bear candle need not engulf the bull candle shadows. The first candle in this pattern could be a doji, and no confirmation is needed, which is really nice if you're new to trading or you're looking for something that's more of a simple pattern to use. We typically like to just see that strong engulfing pattern at the very top of an uptrend, and it's a good opportunity to go short. Bearish engulfing candlestick patterns. The bear candle must engulf, again, the bull candle. Wicks don't matter. Here's an example. We can see significant uptrend, and then we've got nice volume here, and so this would be a great bearish engulfing pattern. I'm trying to look to see if I can show you some bullish as well. Right here is a quick bullish engulfing pattern where we could go long for a brief time, and that's about the only one I'm seeing quickly here. Here's this is an example of a hammer we had gone over earlier. Got a nice little downtrend. That's almost a hammer, not quite, but you could combine other technicals to see that would be a good opportunity to go long. And just stick with bearish engulfing for the time being. See, we've got a nice uptrend, nice price rally, and our bearish engulfing pattern engulfing the bull. That's a great opportunity to go short. Look at some examples. Looking at crude oil, and here on the far left, you see a price decline. We've got a sharp sell-off, and we've got a bull engulfing a bear. Just want to show you multiple examples. So this would be a good opportunity to go long. You've got a nice little hammer there. So these are double confirmation that I should go long. And then when we get at the very top of this market, we can see here we've got a bear engulfing a bull. So two examples of how you can use candlesticks to go long and to go short. And looking for some other opportunities. There's another example of a bullish engulfing. And there's another example of a bearish engulfing pattern. So very great strategy to use, very simple. Looking at the E-mini futures on a daily basis. Back in late June, you can see the market has begun to rally, and our bear engulfs the bull. Great opportunity to go short. Looking for some other opportunity here to see what I can show you in this chart. So I would use this right here as an opportunity to go long. Got a little bit of a rally starting to happen, which sometimes can go a little bit against the grain for using candlesticks, but that's why I use some other indicators to give me a nice confirmation. But that'd be a good opportunity to go long right there with that little hammer pattern. Let's look at the euro again for bearish engulfing. Right here is a little bit of an example. I would qualify that as a bearish engulfing pattern. We've got our bear engulfing the bull. Go short there. And we've got this nice strong rally and another opportunity. This is a perfect bearish engulfing signal right there. I would use that as an opportunity to go short. All right, here's two examples of the euro on a daily basis going back earlier this year. And we can see we've got a nice strong rally, and we've got a bear engulfing the bull. So we could use that to go short. And I would qualify this right here as a hammer. So I'd go short there. When I'd see this, I'd go long. And remember earlier I told you about these kind of inverted hammers that I call them inverted hammers. But I like to use those as an opportunity to go short. Well, here it kind of pins the very top of the market, and you have almost but not quite an engulfing pattern there. But when I would see this, I would be looking for an opportunity to actually short the market. And when I see this next price bar with kind of declining here, this would be a great indication for me to go short. And if I missed that, I could just wait until I saw the next engulfing pattern, and that's a really nice one. So two really good examples of the bearish engulfing strategy. And Let's see here. Is there anything else? I think I put the same slide in here twice. Looking at gold on a weekly basis, there's several examples here that we can kind of spend a little bit of time talking about. Right here, we've got a nice, excuse me for kind of combining these two, but it's nice to kind of compare and contrast the bear and the bull here with the bearish and bullish engulfing. Right here is a great example of this is a kind of a hammer here, and I would use this to actually go long, believe it or not. This is a nice hammer. You could go long there. So these right here, I don't consider this on the left really an engulfing pattern per se. I consider that more of a hammer. And you've got a nice decline in the market, and then you've got a hammer. I would use that to go long. Another decline, a hammer. And then here is a great bullish engulfing pattern, and that's a nice indication that the market's about to rally. And then preceded by that rally, we have a nice bearish engulfing pattern. And again, this is extremely straightforward, extremely simple to apply to your own technical trading. And you can really use this to enhance your trading. It gives you great insight in the market. But here we have the real body of this bull, excuse me, of this bear encompassing or engulfing the bull. So that'd be a good opportunity to go short. And then here's another opportunity. This should be actually circled red as well because this is a bearish engulfing pattern. There's some other examples of some probable trading opportunity in here that you could use with some hammers, I am thinking. Right here, a little bit of a doji. So anyhow, you can use all these different strategies. There's the hammer and the hanging man. Those are kind of very similar. They're just at opposite sides of the market. And the bearish engulfing and the bullish engulfing are the same. So this is really just a very elementary overview of candlesticks and how to unlock the mysteries that are inherent in this charting method. We actually go into much more detail in our live trading room. I'll show up from time to time, but Thomas Wood, the moderator of today's event, is a great futures trader, and he manages our live trade room. So if you'd like to learn more about trading the markets and looking at how candlestick charting works in great detail, we have 2 live trading rooms that are great opportunities for you to get in and learn about all the different trading strategies that we use. We actually go into a great depth of detail in candlestick trading when we get into these live trading rooms. All I've showed you today has been simple strategies, but there's some very complex patterns you can use with candlesticks, and Thomas and David Kino do a phenomenal job in our live trading rooms actually outlining how these patterns and setups work together, how you can combine them with other technical indicators to really enhance your trading. And so our experience is that most live trading rooms do not effectively teach people how to trade, and so our approach is a lot different. We take the philosophy and employ in the live trading room that we're structured to teach you trading strategies that are really designed to achieve steady account growth with a minimal risk per trade. That's extremely important. Risk management and money management is probably one of the core things that lets hedge funds actually survive. So whether you're here just to trade your own account or you're an aspiring hedge fund manager, learning how to take good trades but managing a minimal risk per trade is extremely important. And Thomas and Dave do a great job outlining how to do that. So we focus on trading strategies that seek to minimize your risk and to protect your capital, while at the same time capitalizing on as many higher probability trading opportunities that present themselves throughout this trading session. And so for a limited time, we are going to offer you, as an attendee of this webinar, access to our live trading room. You're going to get a 30-day trial for $7. So for your first month, $7, and you can use these coupon codes. If you want to go to ValueCharts.com, I'm going to pull this up and kind of just show you. Let's see here. ValueCharts.com. I want you to come right to the live trading rooms. And if you want to get into the futures room, you can enroll, sign up. It's typically $149 a month. And when you sign up here and go through our checkout process, you'll use code VCFutures7 or for the futures room. If you're going to go to the options room, just click on live trading room options, same thing. Just go to enroll and you use the code VCOptions7. So you add that into the cart and you'll get great access to Thomas and Dave's trading strategies. Mark Helwig and I will show up from time to time, but with Thomas and Dave, you're in great hands. And I believe that concludes the presentation today. I want to thank you for attending. I believe we're going to take a quick break so that you can get ready for Andrew Keen's up next, and he has a great message for you, a great opportunity. So with that being said, Thomas, I'm going to turn it right back over to you, and you can outline the break session.
All righty. Thank you, Drew. All right, we're going to go ahead and we're going to take about a 10-minute break. When we come back, we'll be having Andrew Keen come on, and he'll be speaking about options trading, floor trader secrets, confessions of a professional options trader. I'm looking forward to that. That's going to be starting right at about 10 o'clock. So again, we'll take about a 10-minute break, and then we'll come back and resume with Andrew Keen. Hey, Andrew, do you want to do a really quick mic check just to make sure everybody can hear you before we get started at 10 o'clock?
Yeah, test 1 2 3, test 1 2 3. 1 2 3 4 5. Can you hear me? Can you hear me? Can you hear me? Can you hear me? Test, 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 test.
All right, looks good.
Okay.
All right, again, we'll be starting here at right about 10 o'clock on the head.
Perfect.
Alrighty, and welcome back everybody to the Value Charts Active Trader Series. We're going to go ahead and get started with our next presenter here. His name is Andrew Keene. He's been an equity options trader on the Chicago Board of Options Exchange for the past 10 years, the majority of which he spent time as being a market maker for over 125 stocks, including big names such as Apple, GE, Sears Holdings, etc. He's going to be talking today, Floor Trader Secrets, Confessions of a Professional Options Trader. If you've ever wanted to ask a market maker what it's like to have their job, what it's like on the other end of the desk, well, he's your man to talk to. So, Andrew, you can go ahead and take it away.
Thanks for having me on. I hope everybody's having a wonderful Saturday. I got some coffee in my system, so I'm ready to roll. So, Floor Trader Secrets, Confessions of a Professional Options Trader. Past performance is not indicative of future results. So, my name is Andrew Keene. I'm sure you guys have all seen me on Bloomberg, CNBC, Fox Business, Sky Australia, BNN Canada. I also do writing contributions for TheStreet.com, Minionville as well. I was a floor trader on the Chicago Board Options Exchange for over a decade. I actually just left the floor about a year and a half ago. I usually start every webinar by telling everybody this is the worst time in history for a market maker, which makes it the best time in history for a retail trader. When I was on the market, when I was on the floor, I traded Apple was my biggest stock towards the end. Between 2006 and 2009, I was the biggest independent Apple trader in the world. So when a hedge fund came in, wanted to make an option trade with me, or my pit, we had 18 traders in the pit. I would say I'm $1 to $1.20, and I was 200 up at the time, usually 500 on spreads, 200 normally. So I was $1 to $1.20, 200 up, and then now we can trade weekly options and we can trade penny-wide markets. So this is a bad opportunity for a market maker, but a great opportunity for a retail trader. Towards the end of my career on the floor, I was paying $8,000 a month for a seat lease, so I figured I can just go upstairs, take all my secrets that I've done from trading on the floor, been profitable for over a decade, and now I'm trading just like you guys. I'm upstairs and I am trading, I have 7 monitors and 2 computers. So I was a market maker in over 125 stocks in my career. I've traded over 1 million equity options and 40 million shares of stock. So I'm a very active trader, to say the least. You hear people that give webinars that say, oh, I only trade in the morning, I trade the opening bell, I only trade on Tuesday, I don't trade in this month, I don't trade in this season. I trade every single day actively from 8 a.m. till 5 p.m. So futures are open 23.25 hours a day. Forex is open 24 hours a day. Equities are open from 6 a.m. Central to 7 p.m. Central. Options are open from 8:30 to 3:15. So every single day I'm on my computer and I'm trading. I'm trading actively. That's what I do for my career to make money. So just a little disclaimer here. Trading options is risky. No one should ever lose any, try to risk money they don't have. Past performance not indicative of future results, and just understand options knowledge before. So I just have to put a little disclaimer up here. So what am I watching? I watch something called paper, okay? There are 8,700 stocks out there that are not pink sheets or yellow sheets or green sheets or blue sheets, okay? 8,700 stocks. 3,200 stocks have options, okay? So every single day I work with a proprietary scanner that shows me every single option trade across every single exchange. So when I was a market maker on the floor, I would trade the 125 classes that was in my pit. Now that I'm upstairs, I can trade anything I want, okay? So I watch the big institutional order flow. So when I talk about paper, paper is an order from a hedge fund, mutual fund, retail bank, or big trader, okay? I watch these trades go down all day long, okay? Do I care what a chart looks like? Yeah, absolutely I care what a chart looks. But all I care about is big dollar amounts, okay? The other day, I saw a trader buy 35,000, okay, TSO, February 60 calls for 50 cents. This is a $1.7 million bet, okay? A trader is buying TSO calls. He thinks the stock is going higher, right? So I want to mimic the hedge fund trades, okay? As I watch these trades going across the tape, I watch 2,000 trades every single day. I try to decipher the best 4 to 6 trades, and I allocate my own capital on these trades. We run a portfolio spreadsheet, and it's based on a $100,000 account. Just on Friday, I was up over $5,000. On the week, I'm up $8,400. On the month, almost $16,000, and then year to date, $76,000. Okay, so this is what I watch. You can trade this with options as well, or you can trade it with stock. So I watch big institutional order flows, taking trades in calls and puts, and then I base my trades on this. What types of trades do I watch? Okay, we have 4 different things I can watch. There's options, get a bad rap in the industry because people think they're really risky. They're actually not really that risky. So I watch 4 trades all day long. Okay, when a trader makes a trade, I have to figure out if it's speculation or a hedge, right? So you see guys watch CNBC during the day, and then I watch Halftime Report as well. We work with a proprietary scanner that shows us these trades, and when you watch CNBC and the Halftime Report, and one of the Nigerians talks about, oh, there's a huge bet in this, there's a huge bet in this, right? That's exactly what I'm watching. I watch the exact same trades, and there's been many days where John Nigerian or Pete Nigerian has set a trade that I already put on like 2 hours ago, okay? So everybody sees these huge hedge fund trades, okay? The hedge funds are smarter than me, okay? I've admitted that a long time ago. They know what they're doing, okay? I have blown out before. Thankfully, it was 8 years ago, and I haven't blown out since because I was on the trading floor. I was a young guy. I thought I was smarter, and the hedge fund came in to do a trade in the stock AMAG, okay? AMAG Pharmaceuticals. Let's just say I still don't know to the day what they do, but I lost $484,000 on this trade. Whenever I get sad, I go home and I bring up my trade conference for the year, and I kind of just laugh at that, It's a learning experience, right? A hedge fund came in, and it was a volatility spread at the time, and I thought I was smarter than him, okay? I thought I was smarter than the hedge fund, and I took the opposite side of his position. And every single day for about 16 weeks, I lost $30,000 a week, okay? So it wasn't like one day the stock went from 10 to 100, okay? Every single day I lost money in AMAG, and it cost me $484,000. And at the time, I think I was in an 80-20 deal with my backer, so 80% of that was my own money, okay? So just figure out and say, hey, the hedge fund's smarter than me, okay? If I can take the really good trades, if I can know all Carl Icahn's positions before, he discloses them to the public, great. We had one the other day in TLM, Talisman Energy. Pete Nigerian talked about it on CNBC during the halftime report 2 days in a row. After the bell, Carl Icahn said that they were taking a big stake in it. Stock ripped to the upside. Okay. So let's talk about a couple of different things here. A trader buys calls. Okay. One of the things that's very important is I have to figure out if a trader has a stock position on against this trade. Okay. I never know. So a trader can buy calls for one of 2 reasons: a hedge against a short stock position, or speculation to the upside. A trader sells calls. Is this protection against a long stock position, or is it speculation to establish a short position? Trader buy a put. Is it protection against a long stock position, or speculation to the downside? Trader sells puts. Protection against short stock, or is it speculation to the upside? Okay. When I watch all these things throughout the decade that I've been watching, okay, my holy grail is when a trader sells puts, okay, and I'll tell you why in a second. And like I said, you can do this in options. You can do it in simple buy or call puts. You can do complex order strategies. I'll do anything from straddle swaps to Brooklyn butterflies, or you can just do stock outright. So I can use all this information to do stock outright as well. So types of order flow, okay? And over the course of my 10 years, this is what I've deciphered, okay? If a paper, and what is paper again, okay, paper is an order from a hedge fund, mutual fund, retail bank, or big trader, okay? So paper just refers to a order, okay? Why do they call it paper? Basically the way that it works, hedge fund has 10 guys that do analysts, they do research, and then the option guy comes up with a trade. He'll call his broker, hey, I need you to buy 35,000 calls in TSO. Then the broker will go to shop the order to Goldman Sachs, Citadel. Then the broker will then bring the order down to the floor, and he'll trade with the market maker. Okay? So the market makers in the pit used to always say, hey, what do you got in that paper? What do you got in that paper? So orders are just referred to as paper. Okay? So if a trader buys calls, what percent of the time is it bullish or what percent of the time is bearish? I would say 60-40. 60% of the time they are buying calls for speculation to the upside. 40% of the time they're buying calls as protection against a short stock position. Paper sells calls. I would say this is a 50-50 bet. Okay, 50-50 bet. Sometimes they're selling calls actually against a long stock position. And my goal when I'm trading throughout the course of the day is to find the trades that are speculation. Okay, I don't care when someone's hedging their position. I want to take big speculative bets. Number 3, paper buys puts. I would say this is 65-35 bullish. And you say to yourself, Andrew, that makes no sense at all. How is 65% bullish? Okay, well, the hedge fund community has gotten much smarter throughout the years. If I personally ran a hedge fund and I knew a stock was going to go from 50 to 100, what would I do? I would not buy calls because that is a flag from the SEC that you know something. So what I would do is I would go out and I'd accumulate stock, okay, and then what I would do is I'd buy puts, okay, puts, yes, puts, not calls. Then when the stock went from 50 to 100, I would make all that money on the stock, and I would just lose a little bit on my puts. Then if the SEC came after me and said, hey, Andrew, you made all this money on stock, I could say, but look at all this money I lost on puts, okay? There's actually a great, there's a great one where Kramer had an interview, Jim Kramer from CNBC, had a thing how he'd buy puts in Apple. He would start a rumor on how Apple is going to have weak numbers. He'd wait for the stock to go down, and then he'd buy all the stock, okay? Because the synthetic of a long put in long stock is long call, okay? So if I knew a stock was going to get bought out, I would not be buying calls. We saw this in HNZ. There's a bunch of traders in Switzerland that are going to probably go to jail, okay? That's childish, right? The smart hedge funds actually buy puts, and we've seen this year in STZ, Joseph A. Banks, LYB. And then we have my holy grail strategy, which is paper sells puts, okay? And this I would say works 80% of the time. We had an order in Workday, WDAY, okay? A trader sold 10,000 October 80 puts. Looked at the chart looked great. So I think there's a floor in that stock at that $80 level. So when Workday, WDAY, got under $80, I started aggressively selling put spreads in October, knowing that this trader, one option, 100 shares of stock, has to buy 1 million shares of stock in WDAY under $80 on October expiration. So I'm thinking there's a really good chance Workday is going to be above $80, okay? So when the market was selling off a couple days ago, I was aggressively going out there and selling put spreads and a lot of the strikes of open interest that I knew that the hedge funds were short puts in, okay? So shorting puts is my favorite strategy. Anytime I see a huge put seller, I get really excited, okay, because I want to put on a trade. Does this work 100% of the time? Absolutely not. Nothing works 100% of the time. You know, if you came to me, I always say this very easy, it's very simple. Someone came to me with $1 million and said, Andrew, I want 90% of my trades to be winners. I would say, easy. I can do that. I would just sell a dollar call spread for 5 cents, right? But, you know, the facts and the truth doesn't lie, okay? My P&L, this on Friday, $5,000. Weekly, $8,400. Monthly, over $16,000. Year to date, $76,000, okay? This is how I traded on the floor. I've made over $5.5 million in my career. $5.5 million trading like this. So who are the institutional paper, okay? We have mutual funds, pension funds, sovereign wealth funds, okay? And they are the big whales, right? I just want to be right under them. I want to be swimming right under them, okay? I am not trading 5,000 lots, 10,000 lots, 20,000 lots, okay? In Workday, you know, they sold 10,000 puts. I don't have capital to sell 10,000 puts, right? So I'm short like 20 put spreads, which I have about $3,000 of risk on that trade. So I just want to see what the whales are doing. I want to swim right under them, and I just want to follow their positions. Then we have the hedge funds. Who are the hedge funds? They are the sharks, right? Carl Icahn, okay, is a perfect example. And he's gotten a lot of notoriety in the last couple of years, okay? Imagine knowing all of Carl Icahn's positions before he discloses them in the public, okay? TSO, the other day, I use this as a perfect example, okay? A trader bought 35,000 TSO February 60 calls, okay? So he has the right, but not obligation, to buy 3.5 million shares of TSO at $60, okay? And the capital that he paid for this was $1.7 million on this trade, okay? That's crazy, you know, to think millions of dollars, okay? I'm not watching $10,000 trades. I'm not watching, you know, stock trade during the day. I'm watching, this is institutional order flow. This is hedge funds, okay? I want to see where they're putting big money at, okay? So what did I do? I bought 50 of these, 50 at 50 cents. Risk, reward. Risk is $2,500, okay? On Friday, these things went to 80 cents. So I've already profited $1,500 on this trade. We had another one in Valero, VLO. These 39 calls. Last week they were bought for 39 cents, okay? 17,000 lot, I think it was. I jumped on at 43. They went to $1.15, okay? So when I'm trading options, I can still, you know, define my risk versus reward setup. I never sell calls naked. I never sell straddles naked. I never sell strangles naked, okay? So I want to make sure I have a risk versus reward setup. So let's look at an example of unusual option activity here. So sweep detected at 11:20. Trader sold, red is sold, 11,500 GERN OCT2 puts for 11 cents. On the bid, implied volatility is 96.9. The market on the screen was 10 bid at 20. GERN is $2.19. Okay? So let's go over example. Sweep detected. That means they took the whole trade. Okay? That means they took the whole trade. Timestamp, this is when it was timestamped from the trading floor. Red, this shows me bought or sold, and these were sold. So some trader came in when the stock was $2.19. He sold October 2 puts. Means he's willing to get long 1.15 million shares of GERN under $2 with a break-even of $1.89. Trade size, 11,500. Symbol, GERN. Expiration, October. Strike 2 put. Type, calls or puts. These are puts. Price traded, 11 cents. Implied volatility. Some people always like to know the implied versus historical volatility. Exchange traded. Should be moved over here. The Amex. Opening or closing. This is very, very important here, guys. And I want to trade opening positions. I do not personally care to see when someone is closing their position. I just want to see when they're opening their position. So I'm watching opening positions and where the stock was trading. So this is an example of something I watched during the day. And then something like this would red flag me. I would say, hey, this guy's aggressively selling puts in GERN. He's willing to get long 1.15 million shares under $2. And if we go back to the last slide, you know, 80% of the time that they are selling puts, they do not have a stock position on. And someone may ask me a great question of why most of the time it's bullish. Well, if you think about it, there's no such thing as a short hedge fund. You can have a short biased hedge fund, but in general, everybody's long the market. Individual investors in the United States are long the market. We have a 401k, we have IRAs, we have SEPs, okay? Most hedge funds are long. So yes, it works best in a bullish environment, okay? Which is, how are we trading now? We're in a great bull run, you know, since 666 in the S&P 500. So this is a great opportunity to trade this strategy. So an example, this was on September 9th. Unusual volume activity, 8.6 times usual volume. A trader sold 11,500 GERN October 2 puts for 11 cents. Their risk on this trade, this should be flipped. So their risk on this trade is $2 million. The risk on this trade is $2 million. The reward is only $126,000. So I just wanted to flip those real quick. So their risk on this trade is $2.173 million. In theory, if the stock goes to zero, they can lose $189 per every option they sold, and their reward is $126,500. Okay. When I give presentations and webinars, I use real-time examples that have happened, within the last couple months. I don't use examples from 2006 or 2009. These are all real-time examples. Okay. I'm an active trader, and I trade every single day, all day long. Okay. So a trader has to buy 1.15 million shares under $2, and the average volume of that stock is 1 million shares. Okay. So I always look at the average volume of the stock. So in theory, if I bought GERN October 2 calls on that day for 30 cents, they were worth $1.80 when I made this presentation, good for 600% profits. So I can use the hedge fund order flow. Okay. Why would someone risk $2 million to make $126,000? That's a very good question. And the answer is, obviously they know something. They know that this stock will not get under $2 by expiration. Okay. Or maybe they're willing to get long the stock at $1.89. If you think it as a percentage point of view, okay, it's a $2 stock and they're getting 11 cents, right? So that's 5.5% returns in like 3 weeks. So that's not a bad return for a hedge fund, right? 5.5% return. So they know that there's a floor in the stock at $2, okay? So if I bought these calls for 30 cents, they would be worth $1.80, good for 600% profit. Next trade, and this is like my standard trade that I talk about all the time. SBAC, this trader did this 2 months in a row. I profited about $3,000 on this trade itself. A trader bought 8,000 February 70 calls for $1.60 on January 16th. Then 8 days later, they sold them for $260. So they paid $160 for an 8,000 lot. They sold them 8 days later for $260. No, the authorities are never going to know because they have more information, right? For the SEC to come after, like they can come after trades that are mergers and acquisitions, but for them to go after every single trade, they don't have the power. It's like saying there's no crime in the United States, right? There's a lot of crime in the United States. What percentage of the crime actually gets convicted? It's a very small percentage, right? So, I watch 2,000 trades every single day, 2,000 trades. So they can't go through every single trade to see if the hedge fund knew something. On the big ones where, a stock goes from 50 to 100, the authorities will go after them exactly. So on this trade, the stock moved $2.18 in an 8-day move or 2.9%, okay? This trader locked in $800,000 profits on this trade. He was risking $1.28 million, okay? So within 8 trading days, this trader locked in 62% profit on a 2.9% move in stock. And the reason I love to trade options as opposed to stock is because I can get that great percentage return, right? And I remember I took this trade in February. I bought a 30 lot. I bought him exactly when that trader bought him. I sold him exactly when he sold them. And I made $3,000, okay? And the best thing about this, guys, if hypothetically speaking, I made this trade and then SBAC got taken over, the minute it is executed on the floor, it becomes a public order, which means that it's available for the world and everybody can now trade on his information and you cannot get in trouble, okay? Because I had this situation when I was on the trading floor, okay? A trader came in and he bought 20,000 calls. And I was like, this guy knows something. So I bought an extra 100 calls, okay? The next day, the stock got taken over. They came into the pit. They said, my guy knows he's going to jail. We need to get out of this trade. We need to bust it, or he knows he's going to jail. So we busted the trade. I had to talk to my lawyer for an hour that day. I said, I bought these calls. Stock got taken over. Are you 100% sure I'm not going to get in any trouble? Because all I'm doing is trading on his information. I'm trading on the hedge fund's information, okay? So once the trade is executed, it becomes fair game. I can never get in trouble for any trade I made, okay? The SEC, whoever, they can't come after me. It becomes a public order. We work with a proprietary scanner that shows us this. So let's talk about the order process here. Basically, the institution will create an order based on their research, information, and analysis. Then they call the broker to get the trade. They'll shop the orders to Barclays, Goldman Sachs, Citadel. Then they'll go to the trading pit, and the market is traded, and then it's executed. Okay. This is not going to work 100% of the time. Okay. There was one in WMB a while back where a trader short puts, and I was aggressively selling put spreads, and it didn't work, and I lost money on that trade. Okay. But you got to always have every trade as a risk versus reward setup. And I always say that the difference between a good trader and a great trader, you should probably write this down, is a good trader looks at how much money they can make. A great trader looks at how much money they can lose. Okay? So the difference between a good trader and a good trader always says, look how much I can make. Well, a great trader says, if I am wrong, how much can I lose? I think every single trade I put on is the greatest trade ever. I take 10 trades a day, probably. I think every trade's the greatest trade ever, but every trade's not going to work. So let's put this all together. Let's come up with a trading plan today, okay? I'm here to come up with a trading plan for you guys, okay? My grandma passed away. She was the best baker I've ever seen in my life. She used to make my grandpa a pie every single day. My grandpa was a pretty large man, and she used to make him a pie from scratch, like not go to the store, buy the crust, and make everything else from scratch. She'd make the crust from scratch as well. And every time she came up, I'm actually from Milwaukee, which I don't like to admit. She'd come up from Milwaukee to Chicago. She'd make us cookies, right? She made the best cookies ever, and I couldn't wait till they came out of the oven, hot, fresh, dip them in milk, right? So let's put these all together and come up with the best recipe possible, okay? Part of trading is coming up with a trading plan. It's great to have all these ideas and these thoughts, but putting it all together in a trading plan, just like a recipe. You take all these, ingredients, and then you make the best thing possible, okay? So I'm here to teach you guys the recipe for trading unusual option activity. I love Milwaukee. So I call this the Oak Rivet Trading Plan, okay? Oak Rivet Trading Plan. The first thing I always look at is the open interest versus volume. I always want to take a trade when the volume is greater than open interest, because I want to take opening positions only. I do not care about closing positions. The chart, is it hedge or speculation? I want to take bullish trades that have bullish charts. If calls are being bought and the chart is bearish, I most likely will not take a trade. I never know a trader's stock position. All I can do is surmise if they have a stock position. So a couple years ago, we saw calls being bought in Vale and XCO. Every single day they were buying calls. And the stock hit a 52-week low every single day. So I do not want to take bullish trades in a bearish chart. A lot of times I see puts being bought on a 52-week high. Most likely, stocks that hit 52-week highs, as everybody knows here, they go higher. So if puts are bought on a 52-week high, most likely, I will not take a trade. I think it is a hedge against a position. So I want to take the speculative bets, not the hedges against positions. R&R. Some people think it's rest and relaxation. I don't. I call it risk and reward. Okay. So always set up a good risk and reward. Okay. I'm sure a bunch of you guys have blown out here before or lost a lot of money in your account. Has anybody lost money in their account before? Has anybody ever blown out of a trading account? It's not fun. I've blown out my trading account twice. The last time I did it was 8 years ago, and I will never do it again. Okay? I thought I was smarter than the hedge fund. I put on a position in AMAG, and I lost $500,000. Okay? So always set up good risk versus reward setup. Break even. It's important to know your break even. Okay? On expiration, where is my break even on this trade? Support, resistance, Fibonacci levels, Ichimoku cloud. How does that line up with the chart? Then we have TNT. Some people call it tacos and tequila. I call it time and target. Okay? Am I giving this trade enough time? Okay? When do I take this trade off? For example, go back to this TSO example. It's a great example. Okay? I bought these TSO calls February. Okay? Most people are like, oh, February, it's a couple months away, right? I look at February as a trader, and I think it's like an eternity away. I have October expiration. I have November expiration. I have December expiration, January and February. It's 5 months away. As a trader, it's a very long time away. So I bought TSO calls. They went from 50 cents 240 cents within 2 days, okay? And I was like, oh, I'm down 20% on these calls. But I didn't think about that. I have 5 months. Not every trade's going to work out the exact day. And it's funny because, you know, my traders always email me, and when there's a profitable day, I know I'm making money, and then I get emails how great I am, and these are the best trades ever, blah, blah, blah. But when there's a bad day, bad days are going to happen, right? You can't make money every single day. This week, I lost $3,000 between Monday and Wednesday. My net P&L on the week was up $8,500, okay? So you got to stick with the trading plan that works, okay? And I'm here to show you the trading plan that works. So, open interest. I want to take trades where the volume is greater than open interest. I want to take open positions. I do not care about closing positions. Chart. Okay, how does the chart look? Like we just talked about, if the chart is bullish and I see puts being bought, I don't need to take a trade. Okay, I can go an hour, 2 hours, 4 hours without making a trade. Okay, on Thursday, I was slinging away. I mean, my trade confirmations is insane. Okay, so I can go as long as I want, and I always say sitting on your hands, right? Physically put your hands down and sit on them if there's no trades, okay? Volatility creates opportunity, but there's not always opportunity. Don't force a trade that is not a good setup. If you have a trading plan and it sets up well, take a trade. If it doesn't, pick your spots, pick your battles. And I always say my goal is to make the most amount of money trading. That's it, okay? I'm not here to make friends, okay? My goal is to make the most amount of money possible. And if there's not a good trade, I don't need to take it. I'm not here to trade. I'm here to make money, okay? That's the big difference. A lot of people are like, well, I think Facebook can go up today. You know, it looks okay, the chart, 2 bearish days, you know, maybe it'll go up. No, if there's no good setup, you don't have to take a trade, right? There's no good setup. Trade's not taken. Then we have, here's the chart. Okay, this is Marathon Petroleum. As you see here, it's in a nice bull channel from the left to the top right. There's no reason to take any bearish trades in this setup. Risk versus reward. Every trade I take, every single trade I take, I want you to find my risk versus reward. Okay? How much I'm willing to lose on this trade. I can look at it as a dollar amount or a percentage amount. Usually I look at stuff as a dollar amount and a percentage amount. Okay? So when I look at Valero, how many calls do I want to buy? I'll buy 50. 2,500, okay? When I buy options, the greatest thing about buying options, they can only go to 0. Just like when you buy a stock, it can only go to 0. I think there's a lot of companies that actually should be worthless, but options and stock can only go to 0. So when I buy calls, they can only go to 0. When I buy puts, they can only go to 0, okay? Reward, okay? Where do I want to piece out of trades, okay? Do I want to sell part of my position for 25% profit, 50% profit, 100% profit, 200% profit, okay? The way I personally trade, I like to take positions off as they're profitable. I never, ever add to losers. I don't add to losers, okay? People think market psychology and trading psychology is to sell as stocks go up and to buy as they go down, okay? Same thing as adding to a loser. It's not a winning proposition, okay? Stop adding to losers, okay? Risk versus reward setups. How much do I want to risk and when do I want to take up this trade? And it works better if you actually physically write it down, okay? I'm going to sell 50% of my position at a 50% gain. We look at the volume versus open interest. So if there's like a 5,000 lot volume and the open interest is 5,000, then most likely they're closing their position, okay? So volume versus open interest. Break even, I always want to know the break even based on the chart, support, resistance, moving averages. TNT, time and target, okay? Am I giving this trade enough time, okay? When I watch this institutional order flow, you know, I usually try to take the same month as most of the hedge funds. So we had one actually the other day in Earthlink, okay? Who knows Earthlink is actually still a company? It's unbelievable. There's 3,200 stocks with options. I probably have traded, I would say in my trading career, at least 12 to 1,500 of those stocks, okay? The other day we saw a huge buyer of Earthlink ELNK, April 5 calls, 45 cents. And the chart didn't look good, but on the daily chart, it had a nice tail at about $4.79. Looked like it could possibly consolidate, move higher. So, yeah, I'll take some of these. April, that's even farther. That's 6 months away, okay? So I bought some of these calls. I'm already up 50% on them, okay? So there's plenty of opportunities to trade, okay? But given these enough time, okay? I don't have many October positions left, okay? Realizing that $500 of risk in October is way riskier than $500 to April, right? Because of time decay. So I have not, actually, I've trimmed my October down very, very small. So I have a lot of November, December, January, February, April. But realizing that $500 of risk in a weekly option is way, way more risk than $500 in April. So make sure you give your trades enough time. Target. Where is my target? Where do I want to take profits, okay? Do I want to take profits as they, you know, as a stock, let's say I buy an option for $1, okay? And we used to have a guy in the trading pit, and I never understood him. They would sell his options for $1. The second he'd buy this option for $1, he would offer it at 110. And I would say to him, Paul, what are you doing? That makes no sense. You're buying an option to try to sell it at 110. So basically, you're risking $1 to make 10 cents. And there's a reason that about 6 months later, he wasn't in the trading pit anymore, okay? So when you put on a trade, where do I want to take it off? And I always say if you write down your trade, you can actually, you know, you're actually going to hold yourself to it, okay? I will take this off here. And stop, you know, I always call it mental, right? Oh, mentally, do I have a stop in? No, I mentally have something in, okay? So write down your targets, okay? Where will I get out of this trade? If it's not working, where do I want to get out? If it is working, where do I get out, okay? I like to piece out of my winners. Usually I sell some for 50% gains, 100% gains, but I always let some ride, okay? I had TMUS calls. They came from PCS. So PCS calls became TMUS1 calls. I bought these for 35 cents, and I bought a 50 lot, and I had 5 of them left till up in about 2 weeks ago, and they went from 35 cents to $2.90, I think, or $3.10, something like that. So I always keep a piece on for a huge, huge winner, okay? I like to piece out of trades. If you think about it, if you buy 20 calls for $1, 20 calls for $1, that's $2,000. If I can then sell 10 of them for $2, that's $2,000. I will have 10 left, and I'll get all my money back. Okay, so if I piece out of trades, I'm getting a lot of my capital back, and then I can just let the winners ride. Okay, why take these trades? The hedge funds and bigger traders have more information than us. And that's why they're getting in trouble for insider information all the time. Trade like the pros. Imagine knowing Carl Icahn's or David Einhorn's position before it was closed. All these trades are public information. All these trades are public information. One little quick story real quick. I was the biggest independent trader in Apple. We had an Apple guy once a week for a year. Okay, he was represented by Merrill Lynch. We have no idea who the trader was. He would sell put spreads once a week in Apple for a year, year and a half. Okay, I got so good at reading order flow and knowing what this guy was doing, the minute I would see the Merrill Lynch broker walking into my pit, I knew he was getting long Apple. So if they're selling put spreads, it means 2 things. 1, they're getting long, and 2, they're selling implied volatility. So I got so good that before the broker came into the pit, I was already getting long Apple because I knew this trader was getting long, and he was good. Summaries and key takeaways. Reading paper does not have its limitations, does have its limitation, is not a holy grail system, okay? If someone says, I have a strategy where you can make 90% of your trades be winners, that's fine, okay? I can create a strategy that has 90% winners. I can have a strategy that has 95% winners, but profitability, okay? Doesn't matter what percentage of your trades are winners, okay? Call buying is not always bullish. Put buying is not always bearish. Bulls can't bluff selling puts. Selling puts is the holy grail strategy. Large paper and unusual option activity help put probability in your favor. okay, by watching what the smart and big money is doing, okay? No trading plan or trading system is without losses, okay? You know, I talk about this a lot too. If I have 3 trades on, okay, let's say one trade, let's say I have 3 trades on, and I'm risking $1,000 per trade. Okay, I have 3 trades on, so I'm risking $3,000 total. Trade number 1, I lose $1,000. Trade number 2, I lose $1,000. Okay. Trade number 3, I was risking $1,000 and I make $4,000 profit. Okay. If you look at what percentage of my trades are winners, well, trade 1 and 2 were losers, and trade 3 was a winner. So I have 1 winner and 2 losers. So if someone said, what percent of your trades are winners, I would say, well, that in this case would be 33%, but I have a net profit. All it matters is money going in your pocket, okay? Profitability, okay? Don't be like, it's like people say that like 90% of my trades are winners. I try to make 10 cents on stock, but then I'll lose $5. Well, profitability is the only thing that matters. So I have made over $5.5 million in my trading career. Whenever I get sad and depressed, I just look at my comp firms. Watch the hedge fund trade and mimic their positions. I've made over $1 million in Apple, not in 1 year, but 2 different years, okay? I was the biggest trader in the Apple pit, and Apple was my bread and butter. To the day, do I still trade Apple? Yes, but not like I did, okay? I put my money where my mouth is, and I actively trade 8 hours a day. If someone says that the opening bell, I trade the opening and then I don't trade. I mean, that's nonsense. The most ridiculous thing I said. I was on the trading pit, and I would never go to lunch, because if I missed a trade that cost me $500, I'd be mad, okay? I would try never actually to go to the restroom either, because I didn't want to go to the restroom and miss that trade. There's many times where people go to lunch. I'm like, hey, how was your $5,000 lunch, okay? Because you can miss a trade at any point in time, okay? So I am actively trading 8 hours a day. Learn from an actual trader with proven track record and P&L statements. Stop guessing and start making money now. And this year, like I said, I'm up 75% on a quote-unquote, for my compliance officer, hypothetical simulated account of $100,000. So we have a workshop on October 29th at 8 p.m. You will learn the Oak Rivet trading plan in more depth. You will learn why volume versus open interest matters so much. I will dissect a whole option trade for one trade and tell you why some trades are good and why some trades aren't. Why I mimic the hedge funds. Different setups for different traders, okay? Some trades set up well for a calls. Some are better for call spread, call fly. There isn't one option strategy that I don't employ, okay? Call spreads, put spreads, iron condor, stock outright, okay? You can use this strategy and philosophy for stock outright, okay? How I use stock volume versus option volume. Figuring out the exit plan and using Andrew Keen's non-blowout trading plan. Learn the secrets that Goldman Sachs doesn't want you to know from the trading floor, okay? What percentage of the speakers have you ever heard traded on the floor for over a decade, have made as much money in their career that I have, and actively trading 8 hours a day? I'm across the street from the Chicago Board Options Exchange, okay? The CEO of the Chicago Board Options Exchange actually used to be my backer, okay? He used to back me. And I tell him whenever I see him, my biggest complaint is I want more hours. More hours means more opportunity to trade, okay? Can you open the, make the options go to 4:30 instead of like 3 o'clock? So we have a special seminar on October 29th, okay? Unusual Option Activity Trader Workshop. Like I said, you can trade this for options or stock. This is a live course. I will be teaching it. It will be recorded and posted online. This is only available for the first 200 students. The price will go up after today. I think it doubles, if not triples. So you can learn how I've made over $5.5 million using these strategies. Learn Carl Icahn, see Carl Icahn and other hedge fund positions before the rest of the public. Take out the guesswork and get profitable now, okay? Learn a confidence scale and avoid blowing out. So this will be recorded, and we only have 200 spots for today. It's $47, so you get 2 hours, and it will be recorded. And you guys can either call or sign up here. And if you guys have any questions, I'm here for about 10 or 15 more minutes. You can ask any questions you want about options, stocks, charts. If you guys have any questions, I'm here. If not, you sign up for our course. It's only $47, and we only have 200 spots. It will sell out. You can email support@keenonthemarket.com. How do you find these trades? We work with a proprietary scanner that shows me every single trade across every exchange. Every single trade across every exchange. In the workshop, we're going to be talking more about the charts. This will be recorded. Yes, we see buy and sells of options. We see buy and sell of options. Today, the only thing we are offering is the course. This workshop, if you're new to options, this will be great for you. You don't even have to be in options. You could be a stock trader, and this will be well worth your $47. We have a 100% money-back guarantee. If you go to the workshop and you're not happy, we'll give you your money back. No questions asked. Why am I teaching? I felt in my lifetime it is my duty to teach people how to trade properly, okay? So I want to teach people the right way. If I could go to Vegas and tell every single guy that has a 12 against a dealer 6 not to hit, I would feel like I'm doing my justice in the service, okay? I taught in a Buddhist monastery in Thailand for 5 weeks. I taught English, okay? I enjoy to teach. Knowledge is power, okay? If you don't have knowledge, there's no reason to be alive. I will die when I'm done learning. This does not work on futures for us, just equity options. The scanner is $500. Even with the scanner, there's no reason to actually have the scanner because I dissect every trade for you. I dissect every trade for you. So the scanner is great and everything. I dissect all the trades for you. And in the course, I will teach you guys how to dissect these trades, how to read the scanner and dissect this trade. I'm not a Buddhist, but I really do like the faith. The only thing we are offering today is the course. The course is the only thing available today. Huh? The course will be recorded. This will be recorded as well. So for $47, you'll get the course as well. Can I make money just on calls? Absolutely. A lot of my trades is just calls. We don't own the rights to the scanner. We don't own the rights to the scanner. So the scanner you'd have to purchase on your own. I think it's $500 a month. But even if you had the scanner, you'd pull your hair out because it's so hard to read. I've been doing this for 8 hours a day for the last decade. Okay. Date of the course is October 29th, but if you cannot attend the course, it will be recorded. So the course will be recorded. The course will sell out. The price will go up to $197, I think, after this week. Since you guys came to the webinar, took your Saturday morning out, we're offering it for $47 today. Yes, I will show you guys how to find these trades. Exactly. I will show you why certain trades are good setups, why certain bad trades are bad setups, why certain trades I risk more money at, why other trades I risk less money at. I come to New York like once a quarter, usually. Every time I come to New York, I co-host a show on Bloomberg for 2 hours with Adam Johnson and Trish Reagan. So every time I come to New York, I do co-host a show on Bloomberg. I'm like the Bloomberg options guy. Anytime they have option questions for me, Matt Miller, they always call me. How much do you need to open an account? That's a great thing. I would say $5,000. I do not think, I don't work for a broker-dealer. I don't have any partnerships with broker-dealers, but I think around $5,000. $5,000. How many trades do you take at a time? Currently, I have about 100 positions on. But we also have another trader that I've hand-taught and I back personally with my own money, and his account is much smaller than mine. I'm trading on a very substantial account. I'm trading a very large account. So he takes about, I'd say 4 trades a day, 3 or 4 trades a day. This will be recorded as well. This will be recorded, yes. Do I have multiple entries? Usually I don't chase trades, so it just depends on the average. I don't chase trades, so I don't have multiple entries usually. Average hold time, I would say between 1 week. Some of them are 1 day. Some of them are 1 week. Some of them are 3 months. Okay. If I have a position that's January 2015, I can wait forever. I had Clearwire calls. They were buying these. They were buying Clearwire calls like crazy, and these things went to 5 cents, and I was just holding them. I have like a year and a half. They ended up going to $1.50. You can sign up on the link. If you're having problems with the link, you can call us right here. The class will be 2 hours long, plus it'll be recorded. The class will be 2 hours long, it'll be recorded. And I will teach you guys everything you need to know to start trading options better, okay? I stand by this course. If you guys are not happy, if you sign up for the course today and you are not happy, no questions asked, I'll give you your money back. Most of my trades in the front month? No, not necessarily. I trade whatever month the hedge fund trades. I trade whatever month the hedge fund trades. I have a lot of Jan 2015s. I have some ODP 2015s. I sold all my OMX calls. After class, can I do this on my own? Yes, hopefully. Hopefully you can do this on your own. I use charts as well. My favorite charting is Ichimoku Cloud. If you guys, we're getting a lot of calls here, so if you guys call, you can write down the number, sign up on the website. If you cannot get through right now, just keep calling. We have 2 phone numbers, 2 phone lines right now. I know a lot of people are trying to sign up right now. Just keep calling. We're here until you are. You would have to email Hubert about that. support@keenonthemarket.com. Just keep calling. We're getting a lot of people. The headset might not be like, look, it's ringing. I might have unplugged the headset. That's why it's not ringing. So if you guys are interested in trading options and interested in seeing how hedge funds make all their money, okay? Anytime you hear someone saying, "Oh, my buddy works for a hedge fund," I always go, "Oh my God," because I know hedge funds in Chicago they print money, literally print money. They're smarter than us. They have more information than us. They have access to more things than us. Okay. Options, you should never pay per trade. Okay, you should never pay per trade. That's what I would say. You should never pay per trade. This seminar is in-depth. This is an in-depth 2-hour course. So if you guys liked what I talked about today, this will get into the nitty-gritty of what I talked about today. So this gets you into the nuts and bolts of unusual option activity. Okay, like I said, I'm looking at my P&L right now. Friday, I made over 5,000. This week, I made over 8,400. Monthly, 16,000. Year-to-date, 76,000. And that's on a hypothetical $100,000 account. Do I ever sell puts to pay for your calls? Sometimes I'll actually in Workday, I sold a put spread to buy a call spread. So I sold a put spread to buy a call spread as kind of a risk reversal. And this one's going to be a little bit different than the last unusual option activity course that I had. So if you guys went to the last one, I'm sure you guys did. We had a huge amount of people turning up for that one. And this one's going to be a little bit different. Okay, I'm putting a couple things into the trading plan. Like I'm comparing now option volume versus stock volume, okay, in the day. So like Workday, we had one the other day in LUX. to make sunglasses for Prada and Ray-Bans. Some traders sold 10,000 puts, and the average stock volume in a day is 70,000 shares. And this trader had to buy 1 million shares under the strike. I'm like, there's 0% chance it's going under the strike. It's 12 times the average stock volume. So in this course, you'll learn about stock volume as well. This course, if you go to this website, it's in at $47 right now. It will get altered to $197 after today, I think after noon or something, after 12 o'clock. So this, if you go in here, it's all set up. You just put in your information, you're good to go. Will there be practice trades after the class that one can participate in, not just past trades? Yeah. The answer to that is yes. You can review this session. I don't know. You would have to. The recordings will be up somewhere. I'm recording it personally, and I think they're recording on their end as well. So we'll be recorded if you guys want to review this. And if you guys can't make it, everything will be recorded. So I would only say about 60% of actually go to the workshop. A lot of people just actually like the recording better. Okay, so if you have an obligation that day or that time doesn't work for you, you can still sign up and you'll get all the recordings. Okay, and then you can review it, go through it at your own pace. You know, the biggest complaint anybody's ever had about me is I talk too fast. So in the recording, which we're going to have, okay, if you sign up today, you'll get the recording and you can just go on your own pace. So only about 60% of the people go to the live course, but the recording is, the most valuable asset of it, because then you can go through it whenever you want. Free retakes because you have the recording. Is the recording? Yeah, I can send it to you via email probably if you sign up. This is a 2-hour class. This is a 2-hour class for $47. And like I said, it will go up to $197 this afternoon. Do you guys have any other questions about options, about trading? It is at, I think, 8 o'clock Central. If you guys have any questions as well, I don't know where I can type something. support@keenonthemarket.com. So after this is over, if you guys have any questions about anything, you can email support@keenonthemarket.com and they can help you with anything you want. I've actually just found out like 2 years ago, or like a couple months ago or something, there were stops on options. I never knew that. So I don't use stops on options at all. Absolutely not. I've never used one before. Why is that? Every time I put on a trade, I know my risk versus reward, okay? So I don't need to use a stop, okay? When I put on a trade, I never sell calls naked. I very rarely sell puts naked. If I sell, put spreads in Workday, I know how much I'm willing to risk initially. There's a reason I put on every single trade. I don't trade just to trade. So I just think stops are ridiculous. An option is a stock. Okay, anytime I come home overnight and I have a stock position on, I freak out because the stock, in theory, I use Apple for an example. Apple's $490. What about if they come out tomorrow and they say the iPhone gives you cancer? Stock's going to go to zero, right? If I'm long calls, I'm stopped out, right? If I'm long stock, I actually have more risk. So that's why I like to trade options instead of stock, because options are a physical stop. I don't want to be an auctioneer. I want to be a trader. I trade anything that has unusual option activity. I'll let options go to zero. Not every trade is going to be a winner. There are going to be some trades that are losers, and I just have to set that in my trading plan. I can have a day that's a loser. I can have a week that's a loser. Does a month that happens a loser? I'm sure it's happened. Okay, but over time, the numbers don't lie.
All right, Andrew, we appreciate it. If anybody has any more questions for Andrew, we're running out of time here, getting ready to roll into the next presenter here, who's going to be Brad Powell. If you have any more questions, you said the email was support@keenonthemarkets.com. Is that correct?
Yeah, keenonthemarket.com.
Keenonthemarket.
Support@keenon.com, yeah.
All right.
You can grow an account for $5,000. I'll answer 2 more questions here, and then you guys can email with any questions. At a $5,000 account, yes, you can grow it. And do I ever sell puts naked? If you think about the risk versus reward setup of selling puts, if you're an income trader and you're just trying to get income, that's a fine strategy. But I try to set up my trades where I get a better risk versus reward setup. Okay? So if you're an income trader and you're just trying to get a couple percent, it's a fine trade. Since you never use stops, how do you get alerted to when to get out? Since you have 100 positions on. I look at my positions. I know every stock, every option position I put on, where I put the position on. So I'll let positions go to zero. Usually like 2 to 3 weeks before expiration, I can either roll my position to a different month or I'll just take it off completely. And I guess that's about it, guys. Thanks for coming, taking your Saturday, spending with me. Thanks for having me on. I'll be happy to come back whenever you guys want, and I'll see everybody soon.
All right. Thanks, Andrew.
Thanks, Brad.
All right, everybody. We're going to go ahead and roll over to the next presenter here, which is going to be Brad Powell. He's going to be discussing.
Hello.
Hey, Brad. How are you?
Can you hear me okay? I'm good. How you doing?
Pretty good. He's going to be talking about the dynamics of today's ETF market. So, Brad, I'll let you go ahead and take it away.
Thank you very much. Unfortunately, hopefully everybody can hear me okay and see my screen okay. I'm fighting the first cold of the season, the joy of having kids bring stuff home from school. My name is Brad Powell. I'm with a company called Right Angle Trading, which is based up in Canada. I'm in Los Angeles. We're kind of a truly virtual company with somebody in Phoenix and Calgary and Vancouver and down in Los Angeles. So welcome to the 21st century. Just a brief history about me. I kind of grew up in the stock market. My father was president of a large retail firm, one of the largest in the country, and then actually was with the SEC for several years before his death. I started trading when I was around 12 or 13, but got interested in something else and kind of worked in the entertainment industry for a while, but gravitated back towards the financial markets. And really, with the advent of electronic trading in 1999, I became a full-time day trader, and have done that ever since. And in the course of trading, it was funny listening. I listened to all of Andrew's conversation. You know, I think we've all blown out an account at one time or another. The question everybody asks, you know, well, why do you do education? Why are you with a company that does this? And for me, I did this for about 5 years, and it gets really stressful when you're sitting alone in front of your computer all day. And I trade futures during the day, and also now very active in ETF trading. It gets very kind of lonely and stressful, and I'm kind of a type A outgoing personality, and so that's really why I kind of do this. I enjoy attending other people's webinars. I enjoy presenting webinars on what we're doing because it gives a chance for social interaction. So that's really, so you know, you always get asked that question. So I'll say right up front, I just got tired of being alone. To be honest, I thought I was going to go insane. So I met at an investors conference, Beth Crow, who was a fund manager and a executive vice president at a brokerage firm in Canada. And she was kind of fascinated with technical analysis going back to the 1980s, and then studied with George Lane, who developed the stochastic and started the Canadian Association of Technical Analysts with Horst Mueller, and was really heavy into technical analysis. And she actually broke her shoulder and was kind of laid up for 6 months, and had developed a strategy that she was working on and actively trading, and decided, you know, that's really what she wanted to do, and left the brokerage business and started the company. So I joined the company in about 2006. And in 2008, what we're going to talk about today are ETFs. We started out kind of focused on futures, and we developed an automated futures trading system, algorithmic system, which we later sold to a small hedge fund last year. It ran for several years. Through various brokers, and we've really put our emphasis on the ETF market over the last couple of years for a number of reasons. And I think Betty was one of the first people to really recognize the growth that the ETF market was going to have when leveraged ETFs were really actively introduced and allowed by the SEC in 2008. So that's kind of what we're going to talk about today. And I'm amazed now at how many people still don't know a lot about the ETF market, and they kind of know what they are and they kind of don't. So I'm going to give a little background on the ETF market, and I'm going to get into some of the specific criteria that we look for picking ETFs to trade, because we're active traders. We had probably one of the first alert services specifically for ETFs. It's now, we have two different services. One is an end of day service done via email, where we give a warning about 2 hours before a trade set up. For instance, we were long the TNA and long the S&P 500 for the entire month of September from our end of day. Get out, got short for a few days. Now we're back in long via the SSO. And then we also have an intraday service where we're issuing trade alerts from the 60-minute, 120-minute charts. And we developed a whole trading course specifically adapting our divergence-based technical studies specifically for ETFs, because there are some interesting charting differences, and I'm going to look at those, and I'll show you some of the tricks we use particularly for trade management, which is so important with the ETF market. So exchange-traded funds, kind of just a little bit of background, and for some of you this will be old information, you already know this. For some of you, you may not know this, so I'll get through it quickly. Exchange-traded funds, or ETFs, are an investment fund traded on a stock exchange as tracking stock for a sector, commodity, currency, bond, and there's really an ETF for just about everything you can imagine nowadays. An ETF's valuation is based on a combination of its net asset value, which is its NAV, and then market fluctuations based on supply and demand. And this is more true in the leveraged ETFs. Tracking stocks like the SPY, are balanced out every day, so they match. The bid and ask are fixed so that they match the movement of the S&P 500 pretty much to the T. That's not true in the case of leveraged ETFs, and this is something that people need to understand about leveraged ETFs, is they are not just simply a tracking stock with 3 times the leverage, and I'm going to get heavy into that in a few minutes. Because we look at leveraged ETFs, and we don't believe they're very good investments. They're awesome for trading, but they don't make good long-term investments, and I'll show you specifically why in a minute. So the original index funds were launched in 1993 as index tracking stocks, and they were the SPY for the S&P 500, the diamonds for the Dow, the Qs for the NASDAQ 100. But in 2008, the SEC approved active management for ETFs, which allows leverage through derivatives, futures, options, bonds, so that you can get, there was a 6 times leveraged ETF. It didn't last very long for the Russell 2000, and it was only a bear ETF. It was odd. It was the RTSA. It was only around for about 6 months because nobody wanted to trade it. But so if the Russell moved 3% in a day, it would move 15, 18% in a day. It was kind of crazy. There are currently over 1,400 ETFs and ETNs available on the market. The difference between an ETF and an ETN, an ETF, an investment is made in equity, so in futures, options, or the actual physical underlying stocks of the sector, whereas an ETN, the leverage is gained through senior secured debt, so typically in bonds. For example, the DGP, the double leveraged gold ETF, they actually gain that leverage through gold bonds. ETFs, this is kind of the staggering figure, currently represent 40% of daily market volume. I did this similar webinar to this 2 years ago, 3 years ago, and that number was at 20% of daily volume, and then 25%, and it's gradually grown, and I actually think it's gone up a little since then. I think it's closer to 45% now since I created this graphic a few months ago, and I think it'll kind of balance out where ETFs, are basically about half of the daily market volume is in ETFs. So that figure alone, old market saying follow the volume, tells you if you're not somehow utilizing ETFs, either through your IRA for longer-term investments, or even actively trading on an intraday basis, and our ETF course kind of ranges from 3-minute charts to weekly charts, depending, kind of suited to the individual investor's needs. But if you're not actively trading ETFs and not involved in today's ETF market, then you're missing out on about half the daily market volume. So it tells you tells us this is an area every investor, every trader should be in one form or another. So one of the primary things I want to look at is, are ETFs actually good investment instruments? And I'm not talking about necessarily the SPY or the DIA for the Dow. Those are more or less fixed price. So they trade the exact percentage of what the underlying index moves on a daily basis. So if you're looking for a 5-year investment in the Dow Jones Industrial Average or in the S&P 500, then of course the SPY is a very good way to do that. An ETF, obviously can be bought just through your brokerage account. But are the leveraged ETFs good investment vehicles or instruments? And this is something that we've really studied and taken a look at. And this is a kind of an eye-opening statistic that I'll show you here. So if you bought the SPY on the first trading day of 2011, at the end of the year, it went up 19.57%, or I'm sorry, over the next 26 months. The SPY pays a dividend quarterly, and then they adjust the price based on the dividend payout. So it returned 23.71% over that 26-month period of time, which is exactly what the S&P 500 did. So simple math would tell you a triple leveraged ETF over that same period of time should have returned 71.11%, right? Triple leverage, 3 times the return. But if you bought the UPRO, which is the triple leveraged bull ETF for the S&P 500 on the first trading day, same day at 70.29, 26 months later, you sold it at its closing price, it only had a 50.69% return instead of the 71.11% that it should have returned. And the reason for that is there's decay in derivatives that are used for the leverage that decrease the return correlation over a long period of time. So the problem with that is it doesn't decrease your initial risk. So anytime you look at, I'm going to take a triple leveraged ETF as a long-term investment, you have to be aware over the next year or two you're going to have decay in the derivatives that are used to gain that leverage, and that's going to work against you. At the same time, you're going to have the same initial risk. So it's really important to understand the ETF market and the leveraged ETF market before you ever try to jump into them. And I want to point out, if the SPY had gone down 23% over that period of time, I promise you the UPRO would have been down a heck of a lot more than 71.11%, because now not only do you have the decline in the underlying market, but also compounded by the decay in the derivatives. So it could have gone down 100 or 150% over that period of time. So that's a really kind of an important statistic to keep in mind, or an important point about leveraged ETFs to keep in mind before you get into them. Let's look at another quick example. If you bought physical gold on 1/3/2012, it increased over the next year 3.6%. So the double leveraged ETF should have returned 7.2%, right? But if you bought the DGP, which is double leveraged gold, on the same day, same closing price at 50.02, your return over the next year was only 2.9%. So in reality, the leveraged ETF returned less than the underlying unleveraged physical deliverable gold in this case. So physical gold return was higher percentage-wise than the double leveraged gold ETF. And again, you were taking on twice as much risk. So these are important factors to keep in mind when looking at ETFs to trade. And probably the most famous case of this was the UNG, and I don't want to rag on the UNG. It got ragged on enough by a lot of institutions and hedge funds because of this, and they've since totally revamped the way the UNG works, and it's the ETF for natural gas. It follows the price of natural gas very well now. They completely revamped management of this ETF. But this was 2 years ago during a period of time when natural gas futures went up 30%, and the UNG actually declined 10% over that period of time. So if you thought, hey, I'm going to jump into natural gas as we go into winter, prices are rising, I'm going to do it via the UNG, you were losing money while the price of natural gas was going up. So why is that? How can that be? Well, the UNG is an actively managed ETF It's not passively managed in the way that something like the SPY or DIA is. So they had chosen options on futures that were about a year, year and a half out, and paid so much premium for those that just to recover their premium over the next year, natural gas futures would have to have gone up over 100%. So a 30% rise wasn't going to make up for the decay in that premium, and so you can see that the UNG continued to go down over a 6-month, 7-month period while natural gas futures rose and then basically stayed flat for that period of time. So it was a horrible investment. You think you're investing in natural gas, but the reality was you were losing money when natural gas was going up. Like I said, the UNG has been completely revamped in the manner in which they invest in natural gas now, and it does a very good job of tracking the price of natural gas now. It's not perfect, but this is kind of the problem that a lot of ETFs have, especially when they're newer, and it's something to be aware of. Just because somebody says, oh, great, now we have an ETF for the such and such market available, palladium futures or something, it doesn't necessarily mean it's going to do what it should. When some of the early leveraged ETFs by Direxion, the FAZ and FAS for the financial sector, triple leveraged ETFs were first introduced. They were both around $200 a share, and then they both ended up at $20 a share. So there's a lot of growing pains sometimes in adjusting the cost of leveraged ETFs to their underlying index and how to gain the leverage. So let's look at some of the advantages of trading ETFs. If you're not already in the ETF market or if you're just getting into it, gives you an exposure to a broad range of indexes, sectors, and commodities that you may not otherwise have access to. Leon, quick question. How do you compare UGAS or DGAS and UNG? Are those leveraged ETFs for natural gas now? I believe they are. I don't really trade the natural gas ETFs, and it's something that we don't like to trade. We trade the oil, the energy sector, and I'll get to this in a minute of our criteria for selecting ETFs to trade. We trade the ERX-CRY, which is the energy sector, and then we trade the SCO, UCO-SCO pair for oil. We don't really like natural gas just because it doesn't have quite as much price movement as some of the others, and it has very inconsistent volume, and it tends to be seasonal, and those are things that we don't like, and I'm going to kind of get into some other examples of that in a minute. So I really don't think I'm qualified to answer that compared to the UNG. I just like to use that as an example because we had some clients that were using the UNG as a long-time investment instrument at the time, and they were getting hammered and said, geez, what's going on? But there was a lot of press about it at the time too. Every day that it seemed like there was an article on it. So some of the advantages of the ETFs are exposure to a broad range of indexes, sectors, and commodities. Each one gives you a range of leverage, allowing you to select what you want to trade based on your own risk tolerance and your own goals as an investor. And an example for the S&P 500, you can go the SPY or the SH, which is the inverse of the SPY, the long and short ETF, with no leverage. So it's going to track the percentage move on a daily basis of the S&P 500, up or down. Or you can go to the SSO SDS pair, which is double leverage, so you get twice the return. Or you can go into the UPRO SPXU for triple leverage. So it all depends, and that's one of the great things about this is about ETFs is they give you a little bit of a choice of what you're comfortable trading as far as your risk tolerance and your ultimate profit goals. The stability of an index won't be as affected by news as individual stocks can be. And that's something I like, especially in something like my IRA, is that, we've all seen Apple or Google open up or down, 10%, 15% the day after their earnings. Google has a big miss. They open up, down $100 a share or whatever. The next time they beat earnings, they're up $100 a share. That doesn't have quite as much effect on the underlying index, so you don't have quite as much risk inherent there. And also ETFs cannot be halted. A good example of that, I'll tell you, was a couple of earnings seasons ago, and we happened to be in the NASDAQ 100 long, and Apple had, and we were up quite a bit on it. This was for our end-of-day service, and we had our stop-loss up in profit, but Apple had a big earnings miss. But on the same day, Netflix, which isn't, is heavily weighted in the NASDAQ 100 as Apple, but they had a very positive earnings report, and so the two kind of help balance each other as far as the QLD, which is the bull ETF that we were in. So the QLD was only down, I think, 0.5% or 1% the next day, while Apple stock by itself was down something like 15%, but Netflix was up 15%, to kind of helped stabilize that a bit, and that's a big advantage of ETFs. Inverse ETFs allow short exposure in retirement accounts. So let's talk just for a quick second about what is an inverse ETF. List of all these ETFs. Judy, yes, we do. We have a list of all these ETFs. Send me an email. I'll give you my email address at the end, and I'm happy to send you out. Kind of great places, Stock Encyclopedia. They have a wonderful section on ETFs. They list every single ETF ever issued. They're usually about a week behind if one gets canceled, but they're right on top of it if a new one. And then you can always check the websites of the big ETF issuers, which are, Direxion and ProShares are really the two biggest now that are kind of dominating the ETF market, and the two that we primarily follow. Inverse ETFs. So what that means is if you go long the SH, it's going to go up while the S&P 500 goes down at the same percentage amount. So it's the inverse ETF for the SPY is the SH. If you wanted to be in a double leveraged inverse ETF by going long the SDS, that would be the same as being short the S&P 500 with twice the leverage, 2 times the return. So that allows you in an IRA, if you're in Canada, in a 401k, if you're in Canada, an RSP, accounts that don't allow you to make physical short sales, or in the case that you may not be able to get borrows to go short, you can just go long the inverse ETF, and there's other reasons that I'll get to in a second why you would want to do that that work to your advantage from a trader's perspective, but the inverse ETFs allow short exposure in accounts that wouldn't otherwise allow them. We looked at the DGP a minute ago, and I do think one great advantage of ETF is if you wanted to get long physical gold, and I have to say I believe the next year the DGP actually outperformed the price of gold. This year I don't think either of them are very good investments, right? Gold's down 30% year to date. The DGP has been getting hammered. But if you thought gold was going to go up over the next year, and I've got kids in college, I've got, I don't have a lot of cash just laying around that I could go out and buy a bunch of Krugerrands, right? But you can use the margin available in your brokerage account to buy something like gold or oil or an overseas market that you may not otherwise have access to, or in the case of gold, that it's just very expensive to buy physical gold, and you may not have the cash available to go and say, I'm going to buy 10 ounces of gold for $14,000 or whatever that would be. I'm sorry, $140,000, whatever that would be right now. But I can use the margin to take a long-term position in the DGP in my brokerage account. So that is one advantage of a lot of these of the ETFs for commodities and, of course, overseas markets. And another advantage is there's relatively low costs associated with trading ETFs, meaning commissions and platforms, compared to something like options that tend to have a little bit higher commissions, or futures, where you typically need to have NinjaTrader, or where you're paying for a trading platform, or you're paying for data feeds. I pay $7 at Ameritrade to trade ETFs in my regular brokerage account. I don't need a special charting platform. You can use whatever you're using for stocks to put a chart up. You don't need special data feeds. They're just stocks. Ultimately they're just equities that trade on ARCA and the New York Stock Exchange, or actually mostly on the Amex as far as the physical exchange. There's no additional fees associated with them, so it's a very low-cost way to get into something like if you want to trade oil, or you want exposure to overseas markets without having to get into an overseas fund that may have higher higher costs. Some of the disadvantages of ETFs: large opening gaps in leveraged ETFs that can work against you. So you wipe out a stop, or we use very tight stops on our trading methodologies. Typically, we'd never have more than 6% risk on a triple leveraged ETF, which would be the equivalent of 2% on an unleveraged ETF, and usually it's a lot tighter than that. We approach it all from a trader's mentality. So you can have a large opening gap in a triple leveraged ETF, much larger than the index, obviously 3 times the index, and it may be a little greater than that. And this is especially true of overseas markets, ETFs, currencies, bonds, commodity ETFs, anything that has substantial price movement while the U.S. equity indexes are closed. For instance, most commodities are very heavily traded in Chicago for 2 hours before the U.S. equity indexes open. In New York, and kind of that prime commodity trading time is before the equity index is open, so that can create a very large opening gap in some of the leveraged commodity ETFs. And of course, the same is true of anything that's traded overseas, and we'll look at some examples of that in a minute, where the whole move might be in the gap based upon what was done in an overseas market while the U.S. equity indexes were closed. Inverse short ETFs have no bottom. And I guess the true could be said of bull ETFs if we were in a steep bear market period. And what I mean by that is you can never look at a leveraged ETF and say, God, that thing's cheap. It's gone down to $5 or $2 or whatever. I might as well take a flyer in it, because they continually do forward and reverse splits on ETFs to try to balance out the inverse, the bull and the bear ETF to the same approximate price. So what that means, if any of you have ever been in a penny stock that was I won't say the term, we all know what it is, for bad penny stocks, and they ended up doing a reverse stock split because they diluted the market, dumping shares. You know what we're talking about here. The inverse ETF, I'll give you an example. The TZA triple leverage inverse ETF had gone from like $50 down to $10 a share. And at $10 a share, it's not very attractive to larger institutions, but also 1 or 2 cent spread actually has a noticeable percentage effect on your trade. So it gets down to $10 a share, and let's say you have 1,000 shares of it at $10 a share. Well, the next day they do a reverse stock split on it. So they kick it back up to $50 a share, but instead of that, 1,000 shares, now you only have 200 shares. They do a 5-for-1, 1-for-5 reverse stock split. So that's something to keep in mind, that they do that periodically on the ETFs. They like to keep them in the $50, $60 range, at least as a starting value, and try to keep them there. And so every 6 months or so they evaluate where the price has gone, and if we're in a big bull run and that inverse ETF has gone way down, they just do a reverse split on it. So you have the same dollar value if you had a position, you just have a lot fewer shares, and then unfortunately it can go straight back down to $5. Leveraged ETFs may not always properly track the underlying index sector commodity due to supply and demand in the open market and the derivatives used for leverage, and that's something we looked at earlier. Decay over time based on derivatives used to gain leverage, depending if they're actively or passively managed. So that's something, again, I have kind of hit this point 2 or 3 times. In the leveraged ETFs, there's going to be decay there in those derivatives over time, and you have to be aware of that. Individual sectors and commodities can come in and out of play with inconsistent volume, and we'll take a look at a couple of examples of that. So when all is said and done, I'm sorry, we'll get to, I'll answer some of these questions closer to the end, and I'll give you my email address at the end. You can always shoot me. I'm always happy to answer questions. So when all is said and done, we believe leveraged ETFs should be traded, not invested in. And I'm specifically talking about leveraged ETFs, and approached with a trader's mentality. And that means limit your initial risk, move stops quickly. So we're really big on stop management. I'm going to show you specifically some tools we use for stop management off my charts, and tell you the indicator settings in a minute that we use for stop management. Look at how they work on these leveraged ETFs, and you can apply it to any methodology you trade. I think it's a good method for looking at how to adjust stops. Take exits, then look for reentry in the opposite direction or the same direction with the current trend. A lot of our trade setups tend to be trend continuation trades, which I'll look at some examples of in a few minutes. Diversify, both with multiple markets and multiple time frames. And that's an interesting point because people don't necessarily think of going from a shorter time frame to a longer time frame to maybe take a hedge position or to be going both ways with the market. And I'll give you an example of that. Last summer, we were actually short the Dow and long the NASDAQ 100 at the same time from different time frames, one from daily and one from an intraday basis. And the NASDAQ 100 went up. Seasonally, it tends to be a little stronger at that period of time, and the Dow laid flat. So we got a nice return out of the NASDAQ 100. Our QLD position exited it, and then over the next few days, the Dow plummeted. And so we got a really nice return. We got like 7% return off the double leveraged ETF over a few days on the Dow position. But you know, because these signals came from different time frames and in different markets, and we considered the seasonality of it, both sides ended up winning, which doesn't always happen. But that was kind of an important point to be able to diversify not only in markets but also through different time frames to pick up different signals if you're a technical trader. Accept small losing trades to be in position for the big winning trades, and let the leverage work in your favor in the short term without ever letting derivative premium decay work against you. What do I mean by that? This is a trade we had a couple of years ago from our end of day. And it's the best example of it. I hate going back. Everything else I'm going to show you is from pretty recent. I'll show you a trade I took yesterday. But I just think this is such a classic example of how derivatives can work in your favor in the short time. SPY declines 14.9% in 1 month. So this was back in July of 2011. So your 3 times return on your triple leveraged ETF should have been 44.7%, right? But the XPXU went up 54.8%. So it actually gave you about 10% better than it should have over that same 1 month. And we entered short right here. So we actually were long the SPXU right here, kind of bounced around for a while and then took off in our favor, and we exited. We actually exited down here, but up at its peak, this percentage gain. Why is that? Well, because the premium and the options that the people managing the SPXU were in increased so dramatically, and that's what they were using to gain their leverage, that premium went up much more than the 3 times that the SPXU should have returned. At the same time, you had tremendous supply and demand issues in the open market. So the XPXU, you know, you would have had to be short almost 4 times the amount, say via the SH, to equal what the leverage gave you in the additional percentage return that the SPXU gave you in that percentage of time. So that's what we mean by letting leverage work in your favor in the short term versus working against you, as we saw over that 26-month period in the SPY versus ViewPro, where you're letting the leverage work against you. Here's another example. This was a trade we took in May, and it's not as good as an example, but it shows even in a very short period of time, the IWM, which is the unleveraged Russell 2000 ETF, the tracking stock for the Russell 2000, went up 6.8%. Triple leverage should equal 20.4, but we got an extra percent, you know, 21.4%, so an extra percentage point over what we should have, just in a little like 2-week period. When we jumped in and got long the TNA, and we got out right up here, not quite at the top, but you can't always time them perfectly, but at least we got out before the drop. And you know, we picked up an extra percentage point by using the triple leveraged ETF, and that was again because of just I think in that case I don't think it was necessarily the premiums on the derivatives they were using as much as just supply and demand, because it was such a just straight line move in the TNA. Our criteria for selecting ETFs to trade on an intraday basis, we want to see high liquidity. We don't want spreads or bad fills in a fast-moving market to impact our percentage returns. So if you look at something like the TNA that trades 15-20 million, and the TZA, that pair, the bull-bear pair for the Russell 2000, 15-20 million shares a day, you don't have to worry about getting in and out of a trade with slippage or a spread impacting your percentage return at all. Even in a very fast-moving market, you don't have to worry about a big slippage on a stop loss getting hit, and that's what we want to see. We don't want to trade these 100,000 a day ETFs yeah, that might be fine for long-term investment, but not for a trader. As a trader, that'll just, you'll get whacked on that. And we want to see consistent volume. We want to see that volume there day in and day out. We also want to see a consistent intraday price movement, not all in the gaps, and I'll look at some examples of that in a second. We want to see something that trends consistently on an intraday basis because we are actively trading intraday and also, staying in position sometimes for up to 6 weeks based on daily charts. For swing trading, high liquidity again, consistent volume, and ETFs that avoid some of these excessive overnight gaps. And here's an example of an ETF with huge overnight gaps. This is the EPI daily. This is the India markets. So if you believe that over a period of time the economy in India is going to grow, and you want to invest in that Indian economy for the next 5 years, the EPI is a fantastic way for you to do that. It is it's a wonderful thing that these markets are open to individual investors now. That you used to have to go into an overseas fund with very expensive fees to get into things like this, and now you can just log into your broker, E-Trade, Ameritrade, whoever, Scottrade, look at the EPI, buy a few shares, and say, wow, I have an investment in the Indian economy for the next 5 years. And I'm not saying it's going to be a good investment. I'm just saying if you believe that. But from a trader's perspective, I don't want to have to deal with these kind of gaps. Well, why is that? Obviously, it's because the Indian markets are open while we're sleeping, or at least while I'm sleeping, and virtually their entire movement every day is going to be in the gap, and you can see how little movement there is price-wise on an intraday versus the overnight gap. The other issue I want to point out on something like this is look at the changes in volume here. Why is that? Well, it's because the holidays in India are going to be at different times than holidays in the United States. As a trader, I don't want to keep track of that. So their market may have been closed for these couple of days, and I don't know why it would still have such a huge gap just based on what the U.S. markets thought they were going to do when they reopened, and yet there was no volume whatsoever there for those moves. So that's why I say something like that as a trader you can get stuck in. DBA daily, this is agriculture. We occasionally take trades in agriculture, and the only thing I want to look at in it, this was, not this past summer, but the summer before when corn futures went up so much, and of course the DBA went ballistic. Look at the difference in volume during the summer versus the winter. And not a lot's going on with agriculture in the winter, right? So it tends to typically drift down in price and have very low volume. So that's something to be aware of. It is an ETF seasonal because as traders, you don't want to suddenly be in a position where it's been trading 2 or 3 million shares one day and the next day it trades 50,000. So that's something to always be aware of. And bonds. I don't want to get heavy into bonds. I'm not a bond trader. Betty does trade the TLT and TBT combo. We sometimes issue alerts on these. On positions that she might be doing. But I ran an interesting test. A couple of things I don't like as a trader about the TLT, about trading the bond ETFs, is I don't like the overnight gaps because of what the dollar has done. And I also don't like the inconsistent volume because it is very news-driven and rate-driven. I did a study where I looked at the TLT. If you wanted to go long bonds over a 3-year period, and plus the dividends they pay a monthly dividend, how would that have compared to some of the other bond funds? And I have to tell you some of the very simple, I'm not promoting anybody's bond funds, I'll just say, I have access to some PIMCO funds through Ameritrade. There's many other companies that are very safe bond funds that return, 4.5% annually with very little risk, 5% annually, and they've done some. Those very safe bond funds for an IRA or for getting a portion of your money in the bond market far outperform the TLT over a period of 3 years, which I found very interesting. So our ETF favorites that we like to trade day in and day out that have proven themselves over the years to properly track the underlying index. We like the TNA TZA on an intraday basis, triple leveraged Russell 2000 ETFs, EDC, which is triple leveraged emerging markets. And I'm just going to mention that real quick. The emerging markets can't have very large gaps, and we can have a rule that if it has over a 4% gap in it, then we leave it alone for the day because it might not have a lot of room left in it on an intraday basis. But some of the markets that comprise the emerging markets are actually open at the same time as the U.S. equity indexes. The Brazil market, which is very heavily weighted, and some of the African markets are still trading in South Africa. But for instance, the largest component of the EDC-EDZ is Samsung, which is traded on the Korean market, so that impacts the gap, what Samsung has done overnight. But compared to some of the individual, like the China ETFs, that don't move quite as much intraday while our equity indexes are open, there still is price movement on the EDC-EDZ, so we like them, but again, we have that kind of 4% rule. If the gap's over 4%, we leave it alone for the day. UCO-SCO, double leverage pair. So again, we have the bull first and the bear second. UPRO-SPXU, AGQ-ZSL for silver, great trading pair. Intraday basis, it's very volatile with very high percentage return, ERX, ERY for the energy sector, and FAS, FAZ. So these all have consistent volume, consistent price movement, and it's not all in the gaps. And then for swing, one of the things we like to do is on these longer term trades, because we don't want that leverage to work against us if we end up staying in a position. I mean, we went long the TNA and the SSO at the end of August and stayed long until the beginning of October. Got very nice returns on those trades for our end-of-day service, but that's really about as long as we want to stay in there. After that 30-day period, some of that leverage might start working against us. So we use the triple leverage ETF for that on the Russell 2000 on those particular trades, but on the S&P 500 we backed off to the double leverage just to reduce risk a little bit and kind of balance out, since the Russell 2000 can be so volatile. So we like the DDM DXD, QLD, QID for the NAS 100, SSO, SDS, ERX, ERY, again, triple leveraged energy, and the triple leveraged financials. And, you know, there's more volume in the triples than there are the doubles, actually, on the financials and the energy, so we don't even look at the doubles on those. EDC, EDC, and then we also like the UPRO SPXU triple leverage S&P 500. And, you know, there's 1,400 ETFs out there, and yet we whittle it down to, you know, about 8 or 10 pairs that we're actually actively trading, maybe 12 pairs, because these are the ones that, number one, have proven themselves to track the underlying index over years. They have that consistent volume we want to see day in and day out, and they meet all of our criteria for trading instruments as opposed to long-term investment instruments. So what do we think is the most important aspect of trading leveraged ETFs? And when all is said and done, we think it's trade management. So I'm going to show you some specific examples of trade management. The first thing I want to do is just show you what I have on this chart. We're looking at an ERX 120-minute chart. It's the energy sector triple leverage bull ETF. And I've got this, I've made some bright colors for the webinar. Hopefully you can see everything. You know, as far as like comparing some of these individual things, just shoot me an email. I'll give you I'm going to give you my email at the end. As far as asking about the individual ETFs, I don't really want to waste time covering it here. We use we use candlestick charts. Let me tell you what we do as traders. We're technical traders. I trade the NQ intraday. Betty trades the ES. We're also actively trading ETFs. We have another guy in Phoenix who does our programming, and also he trades ETFs. We're all on Skype all day together. We're issuing alerts on an intraday basis from like hourly charts, 120-minute charts for 2 to 3 day swing trades. And then we're issuing our end-of-day alerts via email where we send a warning out a couple hours before the trade. On my chart, we have stochastics with it's not on this particular chart with our custom inputs that actually Betty worked on for many years and working with George Lang for shorter-term trading. Some settings for it. We have trend indicators. We have another momentum indicator. And everything is divergence-based, so we're looking for regular divergence for reversals, and we're looking for hidden divergence confirmed by our trend indicators for trend continuation trades. What I have on my chart here that we're really using for trade management is an implied volatility indicator, which is a Keltner channel. This is the outer magenta bands that you see. And the input on that, the ATR input, is 2.5. So we've opened it way out. And what I want to show you, and we'll look at this at different time frames, is very rarely at that 2.5 setting will it stay outside for more than a couple of candles, at least on these swing time frames. And that's important to note. Then I've got a second Keltner channel, which is the little dotted line in here, at 1.25. So that's half the spread between the outer band and the center line. The center line is gray. Now the center line of a Keltner is just a 20-period simple moving average, but what we like instead of the center line is a 20-period exponential moving average, which is the first indicator I put on every chart, and it's this green indicator in the middle. So I've got a 20-period EMA, a Keltner at 1.25, the ATR at 1.25, and a Keltner at 2.5. What this is doing is providing me with two pieces of information. It's providing me with the 20-period EMA an expected pivot point for a trend. And if you look at once the ERX starts trending, every key pivot, 1, 2, 3, 4, that occurred in this uptrend occurred right on the 20-period EMA. Never did it stay outside the Keltner channel for longer than a couple of candles at these settings. Same thing on the way down. Key pivots, resistance area coming right around this 20-period EMA. Pivots here, it kind of got choppy. When you see it trading up and down over it, you know you're in a choppy market. You can just take a look at that, block out half of that and say, oh, it's not, pivoting on the 20 EMA, it's bouncing around between it, and it's using these 1.25 Keltners actually as support and resistance. That's usually indicative of a choppy market, a trendless market that may be setting up for a reversal. And sure enough, it broke down, and once it broke down, it got back into using it. But look at this uptrend, and then look when it was in a reversal period, it was using kind of that midpoint in there, or the lower band of the Keltner. So that's something. So I want to look at a trade from yesterday. So this is a TNA 5-minute chart, Russell 2000 triple leveraged bull ETF. And we got a long signal yesterday morning, a setup for a trend continuation trade from the prior day. And I'm going to talk about specifically stop management on this trade. And so entry was right here at about 61.75 on the trade issue. And for my initial stop, what I'm going to do is I'm going to look at where did this close? It closed right over the 20-period EMA. So my initial stop, I'm going to my next implied support and resistance area and volatility or implied trading range indicator, which is this 1.25 Keltner. And I'm going to set my stop a little bit below that. And so I ended up with about 1% risk on this trade. So when I entered the trade, it was actually just a little bit less than 1% risk. So you can jump in, 500 shares. I've got about $350 worth of risk on it, and as far as my initial risk, and we always try to trade at roughly a 3 or 4 to 1 reward to risk ratio for a number of reasons. So let's see what happens with this trade. As it moves up, it hits a little bit of resistance in this, and I'm going to try to zoom in a little bit on this. It hits a little bit of resistance right here in the at that 1.25 Keltner area, and it comes back down and forms another pivot. Where does this pivot form? To the penny on the 20-period EMA. For 4 candles, for 20 minutes, it's bouncing off that 20-period EMA. So I've already moved my stop up. So now I've got about 20 cents of risk on this trade. So I've already moved my stop up a little bit below that 20 EMA. I want to be protected against what I call a poke, where just you get a tail that pokes down there a little bit. And then as the trade goes up, and now it busts out over that 2.5 Keltner channel. So now I've probably got a runner on this trade. So I'm moving my stop up, and I'm just going to move it up every 15 or 20 minutes following that 20-period EMA, leaving room for a poke, and I'm going to stay with this trade. And you get a nice, big, strong bull move. My stop's way up in profit, and I'm just going to stay with it until a candle closes back inside that Keltner channel. And so I get out with about a 3.5% profit on the trade. So I'm in it for this 5-minute chart, about an hour and a half. You end up with a 2-hour trade. Get a nice little 3.5–4% profit off of it versus less than 1% initial risk. But the important thing is my stop management. I was never going to let this trade go back against me. And the second I saw an opportunity, a pivot forming here off that 20 EMA again, my stop has gone up right under that 20 period EMA, leaving a little bit of room for a poke, maybe 10 cents on a $60 ETF. And you can see as I got out, sure, I couldn't time it to the penny, but the rest of the day we had kind of a flatline chop. So let's take the same principle on a 180-minute chart, which is what we use for the TNA on our intraday alerts. What is the moving average? The moving average is in green, Neil, and it's 20 period EMA. The outer band of the Keltner, the purple one, is at 2.5. So everything stays out of the box setting except what in TradeStation is called the ATR. Different platforms call it different things. But normally the default setting that you'll see is 1.5. Change that to a 2.5. And then I have another Keltner where I change it to 1.25. And then rather than using the midline of the Keltner, I'm really watching the 20 period EMA. So here's another trade setup that we took that we give our clients. And I want to look at the trade management on it. And we had it both from intraday time frames and daily. So we actually managed it from the daily. But I want to show you management from this on 180-minute. So I have my day marks in here so you can see. So we get a long signal on the TNA, the triple leverage Russell ETF. And again, it's right over the 20 period EMA is where it closes. So I'm going back down to this most recent price pivot. I'm actually going to go below where that 1.25 Keltner is. And I'm going to put my stop a little bit below this most recent price pivot. So it kind of goes up, and as you can see, we had this crazy day where we had kind of the market went way down and came right back up, and later in that day it comes back down again, and it kind of pivots right off of the 20 period EMA, and then it starts to bust up over that 1.25 Keltner. So at that point I can move my stop up under the 20 EMA. I'm almost at break even, and the next day it gaps up and over the Keltner, so I'm bringing my stop up now. All right, so this is a pretty strong move up and out of the Keltner, but the Keltner has become compressed here, so we're going to stay with this trade, and just every few days we're going to move, or every few hours we're going to move our stop up under that 20 EMA. When it moves, we're moving up until we see our third pop out of the Keltner on these time frames, and then we're going to take our exit when it comes back inside that 2.5. And again, you're never going to time a top perfectly. You could have got a little more, but we went into a choppy market here. So we caught the trend, the important part of the trend. And during this period of this chop out here, I just want to tell you, I was watching and we were tracking it, the leverage, the decay in the leverage really started working against you very quickly here, whereas we picked up some about 2% extra than we in the leverage here as far as the move versus 3 times the unleveraged. And that's something I'm always conscious of, what little extra percentage. Well, excuse me, I'm sorry, I told you I'm fighting this cold. Extra 2% a month from one trade over the course of a year is an extra 25%. So simply because of the leverage. So that's letting the leverage not work against you. That's an important, that's a substantial number over the course of a year. So again, you can see how the pivots are occurring right at that 20 period EMA. The 2.5 Keltner channel gives me a good idea when it's going to pull back as soon as it gets out of there. It never stays out of there for very long, I can use that 20 period EMA to adjust my stop. Always give it a little room for a poke. Here we had a big poke and got lucky, and these were trades we were in with our clients. And we teach these setups in our courses. And earlier I spoke a little bit about diversifying, and I'm going to go through this really quickly and try to get some of these questions. Diversifying not only in different markets but in different time frames. And what we do for our intraday alerts is we use a different time frame for every market. And sometimes we're long and short at the same time, and sometimes both of those trades will win. Sometimes it will just protect you. We happen to be long the SPXU the other day, so short the S&P 500, but we were in a bull position on the FAS, triple financial sector. Well, that one stopped out, but the SPXU obviously went our direction as that one was stopping out and then some. So, it's important to be able to do it. So what we call our aggressive portfolio, and this was a 30-month non-compounded return, so it's returning a little over 100% a year. Compounded, if you were to compound quarterly, you can get that up to 400 or 500%, obviously. But if you break it down by the individual markets, look at this drawdown period here for about 20 trades, 15 trades. If you were only trading one market, you had about a 10 or 15% drawdown on a triple leverage ETF over that period of time. But at the same time, the energy sector happened to be going up during that same period of time and was a little more stable. And if you were in the Dow during that period of time, it actually was going straight up. So the NASDAQ was impacting the S&P 500. And so that's kind of what I mean by diversifying not only in multiple markets, but also multiple time frames. That allows you to balance your overall portfolio. And, you can see there's a period of time the financial sector can come in and out of play. And that's always something to be aware of with the FAS. It could just hit a period where the banks aren't doing anything, interest rates aren't moving, there's no news. And, to us, 20% drawdown is a pretty substantial drawdown, even in a triple leverage ETF, and over a period of 10 or 12 trades, which is like 3 or 4 months. But during that period of time, something like the Russell 2000 might be making you money, or the NASDAQ 100 when it suddenly kicks up. I think we happen to get long or short, whatever the NASDAQ did during that period of time. And so you can compare that in these multiple, by balancing out different time frames, different markets, somewhere you're making money, and what it does in the end is allows you a nice steady portfolio growth, and that's the kind of equity curve you want to see without lengthy drawdowns. Yeah, you're going to have a little 10% drawdown at some point over a 20 or 30 trade. We're traders, we expect that. We know we're going to have drawdown periods. We also know we're going to have our big run-ups. And sometimes you get lucky like we did in September. We hardly took any trades in September because we were so heavily long early in the month that the only thing we had to do was manage our stops. And I had this conversation with a client the other day. He said, I'd rather take that one trade that we get 15% on, and all I've got to do is properly manage my stop, than take 7 winning trades and 3 losing trades that end up, because I'm just spending money on commission when I do that, So you could have 7 winners and 3 losers and make your 15%. We ended up doing about 20, 25% on a couple of trades over the course of a month, and had a very good month because we didn't do much. We just got long early and stayed with the signals, and I showed you one of the trades, and we just kind of do it all through stop management after that. Those are the kind of trades. Jeff, I'll tell you, I'll go back. What are the ones we recommend for trading? I'm going to quickly scroll back. Right here, you can limit it to these 1, 2, 3, 4, 5, 6, 7 pair. And the ones here, another 7 pair, maybe 12 or 14 pair. That these have the volume. Like, we don't like the triple leverage Dow ETFs because I've seen them go from 2 million one day to 100,000 in volume the next day. That's crazy. I don't want to be stuck in a big position, with 1,000 shares or 2,000 shares on, and knowing that clients are in there as well, and we jump in at 2, on the day it has 2 million in volume, the next day we have to get out and it only trades 100,000. We could be half the volume, us and our clients. So, that's why we don't use the triple leverage Dow ETFs, just the volume is too inconsistent. But if you, keep yourself locked to those ETF pairs, it gives you a lot of flexibility. Why trade ETFs instead of futures or single stocks? The stability of having a sector behind you instead of individual stocks. And I won't hold futures overnight. I day trade futures. I day trade the NQ. I have specific hours of the day I like it. I won't stay in futures overnight. But in my IRA, I can pop off these ETF trades. It's easy. I mean, you saw in that trade from the 5-minute chart, I can just jump into that while I'm trading futures, and then it's all stop management. Once I'm in the position, it's all stop management. If I stop out, if it hits my initial stop, I'm out, and I'll kind of watch for the next setup. My favorite ETF for trading is the TNA TZA pair. Without a doubt, consistency, high volume, great price movement, nothing beats the Russell 2000 TNA TCA. And, you know, I've never liked trading Russell futures. It's funny. I remember the ER in the old days when it actually had really great volume, and then the TF, since it moved to ICE, has never had the kind of volume it used to have where it was over 1 million a day all the time. So I much prefer those trading the Russell ETFs compared to anything else. And I'll tell you something, if you watch futures, if you're trading futures, put up an ETF and put up your futures chart and see which moves first. And I guarantee you, you'll get a better clue to what the market is doing, not from futures, but based on what the triple leveraged ETF is doing. The UPRO will shoot up before the futures do. The futures will end up following that ETF because it's a composite, you know, of everything in the S&P 500. But big money knows what's going to happen, right? And big money is moving into something like the UPRO for the leverage, and you can see the volume kick up in that or in the TNA and watch it move, and the futures will follow it. I actually think that leveraged ETFs lead today's markets. I believe it is the absolute best clue, to the point that we've actually considered a whole strategy based on looking at setups in the ETF and taking them in the futures. I mean, it's kind of funny. I'll tell you what we have going on because my time's up. I'm going to do this really fast. I'm not even going to go through it. Right now, it's on our homepage, on our website, www.rightangletrading.com. We have 4 months of our ETF live trade alerts, plus our entire course and mentoring program, where it's monthly webinar, one-on-one support via email. We'll also log in one-on-one with you into our webinar room, go through charts. So it's our whole course. It's about a 200-page home study ebook and mentoring program, live monthly, live trading, live monthly webinars, and 4 months of our ETF alerts for $4.95. It's an $18.91 value. We also have our end-of-day alerts on a monthly basis and our intraday alerts, which we'll be opening up some free trials on too soon if you're interested in that. If you have any questions, I'm out of time. As usual, I talk too much. I ran over a little bit. Sorry about that, guys. Brad Powell at rightangletrading.com is my email. I will answer all the unanswered questions. Just shoot me an email, and I'll get back to you sometime tomorrow over the weekend. www.rightangletrading.com, and we have this special right at the top of the page. Thank you guys for coming today. I hope you learned something about the ETF markets today, and it was a pleasure being here, and I want to thank ValueCharts for having me in for the presentation.
All righty. Thank you, Brad. Next, we're going to have Bennett McDowell here talking. He's coming from traderscoach.com. He's going to be discussing money management formulas that help you secure profits. Money management, very, very important to being successful traders. So, Bennett, I want to go ahead and make you the presenter. Just do a really quick mic check if you can.
Okay, I'm here. Give me 1 second just to get set up, and I'll be right there with you.
Excellent. All right, I'll go ahead and hand it off to you and let you go ahead and take over.
Okay, do you see, you should see a PowerPoint in front of you. Is that what you see right now?
It looks good, Bennett.
Okay, good. Thank you. Okay, I just want to make sure. And I assume everybody can hear me all right, so let's go ahead and get started. Well, thank you. I just want to thank everybody for attending. I know Saturday morning is a good time to get outside and do a lot of things. I want to thank eSignal also for hosting this, and of course Drew as well for putting it all together. So thank you, everybody, for all the efforts involved. Quick disclaimer before we get going. Just so you know, there's risk in the markets. I'm sure every speaker has told you that already, so that's not new news. But you know, without that risk, there's no opportunity. So remember, the two always go hand in hand, and if something seems too easy, it usually is. So the fact that trading is difficult is exactly what makes it exciting, and when you're successful, that's what makes it very profitable. So don't forget the two things. I've written a couple books here on money management, which is going to be our topic for today. The book on the left is called A Trader's Money Management System, and the book on the right is A Survival Guide for Traders. Both these books are available at major bookstores and, of course, at Amazon, where you can actually read the reviews. But these books will cover money management and a lot of the topics that I'm going to be talking about today. So if you want more information, this is a great place to go to get that, and you can get those online very easily. I think they're even ebooks at this point as well. All right, let's talk about money management and risk control. Why do you need it? All right, do you need it at all? You know, there's some systems out there that they say, I don't even want to use stops. All right, so why do we really need risk control? Well, it's important to note when we talk about trading that not every trade will be a winner, okay? And we're traders, we're not investors. Usually folks that don't use any type of risk control or stop loss program have more of an investor mentality, because you got to remember, as an investor, you're really planning for a future outcome, and you're basing your decisions on historical returns. As traders, we're kind of more going with the momentum, aren't we? We're trend traders, maybe scalpers, but in any case, our time horizon is much shorter than that of an investor. So we have to get out of bad trades. We don't have the luxury of having time bail us out like an investor. You know, there's certain statistics on portfolio management that say if you buy into a stock, a decent, good quality stock, that even though the short-term fluctuations may bring your situation to a short-term loss, open loss, over time, the market should recover and you'll make money. And so that's the credo of the investor. As traders, we don't have that kind of time to wait years and years. We're traders. We're trading the momentum of the market. We have to use some form of risk control to get us out of those trades that aren't winning, because some losing trades for active traders is a normal situation. It's a normal part of trading. So I think that's the psychology you got to bring to money management when you first start out. Now, money management is really a wonderful thing because it allows you to be wrong. If you have a good money management system using the proper risk percentage, and we're going to talk about all this, okay, you can actually be wrong quite a bit and still do it extremely well. All right, it helps control your risk. You'll know the risk going into each and every trade if you're doing it right. Takes into account that every trade can be a potential loss. Again, this is more of a mindset. Obviously, when we take trades, we don't sit there and expect them to be a loss, but we prepare for them in case they are. So that's a very important aspect. It's the mindset. Really separates, risk control really separates the pros from the novices. And like I said before, money management is a state of mind. So you have to have the mindset that you need risk control. And it's very interesting because that mindset either can begin at the very start of your career, or I'm sure after you've had that one or two big losses, you'll start to believe in the importance of risk control. So eventually you'll get to the same endpoint, realizing that risk control for short-term trading is a must. All right, some important elements of money management that we need to discuss. How much to risk on each trade? Calculating the trade risk, calculating the trade size, risk management, and talking about the risk of ruin, and then, of course, effective stop-loss placement. The nice thing about what I'm going to cover today is this is not about a trading system today. And believe me, we have those, but this is not what this topic's about today. This topic is about how you can use your current approach and add money management and risk control to it. So you start trading, all right, with a sound foundation of risk control. That's what this topic's all about today. So I don't really care how you enter and exit the markets. That's up to you and your particular system or approach that you like. But I do care if you're not using money management or risk control. And that's the folks I'm hoping to reach here. All right, so let's go on here. Now, obviously, you don't have to actually answer this, but you can think about it to yourself. But here's a great question that I always like to ask when I speak at the trading expos and so forth on money management, because it really makes folks think. I want you to think of an experience where you suffered an excessive loss, maybe earlier in your career, because you did not use risk control. Then I want you to ask yourself, here's the key, why did I not use money management and risk control? And then ask yourself, when you were in the trade and it wasn't going well, how did it feel? All right, I can bet if you can think back that far, one of the reasons you didn't use money management is because you were relying on your forecast and everything that you take into account to generate that forecast as still valid. You still thought the market was going to recover, whether it was a long trade or a short trade. However, when it didn't and kept going against you, you started to feel pretty bad, didn't you? You started to get into that spiral down to a point where the loss that you actually could close out and take was too large for you to emotionally handle, and maybe too large for your trading account size as well. This is exactly the kind of spiral that happens that gets people in trouble. And usually after an event like this, it triggers the need. It changes your mindset to needing risk control. You actually begin to see the need for risk control, whereas before you didn't really feel you needed it. So what, again, we're trying to do here in this webinar is get to you before you have an experience like that, especially if you're new. And if you're a veteran, all right, you're kind of on my page already, but maybe you need some pointers on how to do that. So this webinar is both for the novices and the more experienced traders, because healthy money management psychology really, again, I can't drive this point home enough, occurs when you believe and acknowledge that each trade's outcome is really unknown at the time you enter the trade. You don't really know. I mean, some trades you think, I'm sure, are going to be huge winners. I know for me, that's the case. I'll look at something that looks really good, and then all of a sudden, that trade didn't turn out as good as another trade that I thought was marginal. Thank goodness I had risk control on all my trades, because it limits my losses on those trades that I get stopped out of, even the ones I thought were going to do great. Now, I want to talk to you about two types of risk. Okay, there's trade risk and there's market risk. And one of the reasons we need to discuss this is because you have to understand the difference. All right, trade risk is something we as traders can control. Market risk are events that we cannot control in the marketplace and really have no foresight as to when they come. Example, a terrorist attack, some major news announcement, et cetera, et cetera. All right, a world event of any type. So what we're going to attempt to do with our risk control foundation or procedures or rules is the trade size, okay, that we use. Now, trade size is the same thing as position size. You've probably heard both terms used in the industry. And position and trade size means how many shares of a stock you're going to buy or short with on that trade, or how many contracts if you're trading the futures, or how many pips, okay? It's your size, it's your trade size, so to speak. All right, trade size, we've developed a system here where trade size can control your trade risk. So when we enter a trade and we talk about, for example, not risking more than 2%, et cetera, we're talking about controlling our trade risk with our trade size, okay? The account size, in other words, your trading account size, the dollars in your account, controls the market risk. So this is the adage you've probably all heard, okay, never trade with anything but risk capital. And this is why. Because most people, professional traders for sure, they're not going to actively trade their entire net worth because of market risk. They know if they have a market risk event that the market may jump or gap way past their carefully chosen stop loss based on calculating trade size with trade risk. And so therefore market risk supersedes trade risk in terms of what it can do to offset your carefully chosen risk control parameters. So the only way to protect yourself against market risk is to put dollars in your trading account that are truly part of your risk capital, and this should be a percentage of your net worth. And this is why traders, even professional traders, don't trade their entire net worth because of market risk. So it's important for you to realize the differences and what we're trying to control here when we talk about risk control and money management, and what we cannot control. And market risk is something we cannot control, but ultimately we control it by putting dollars in our account that are risk dollars. So I think that's important. Okay, many traders, I do a lot of consulting and coaching and so forth, and I've been at this quite a long time. And what I've noticed is that novice traders usually trade the same trade size, remember that's position size, on every trade, and change their stop loss exits to accommodate their trade size. This is wrong. And why it's wrong is because you want to have your stops set on key levels in the market, because those levels have meaning. You don't want to be moving your stop up to levels that have no meaning in the market just because you're trying to achieve a large trade size. And we're going to discuss this a little further, and I'll show you what this means. All right? Instead, the trade size should change to accommodate, okay, their carefully chosen exit, taking into account their win ratio and payoff ratios. We're going to show you how we do this in a very neat little format here in just a minute. So this is important because what you want to do is develop a system that's consistent. And if you go into a trade and you just randomly select a price level that you need to get out of, based on it will allow you to have 1,000 shares long, and if you get stopped out, you're getting stopped out at a certain % risk. That level that you've chosen may not be a level actually set by the market. And if that's the case, then you're really kind of randomly selecting where you're going to put your stop. And we don't want you to do that. All right, just a little bit of education on win ratio, payoff ratio, and capital to risk. All right, win ratio, for those of you that are new, are how many trades do you win versus basically how many trades do you lose. You know, if you have a 60% win ratio, then obviously you're winning roughly 6 out of every 10 trades, right? Payoff ratio is an interesting aspect. It's how many dollars do you make for every dollar you lose. All right, that's called your payoff ratio. Capital to risk is what is the optimum amount of capital to risk on each trade. All right, so knowing that information, here's a couple little formulas, all right, that basically depict the win ratio and the payoff ratio, all right? Pretty easy to do, actually. All right, so if you're winning trades on the payoff ratio at the bottom there, if you're winning an average of $300 per trade and you're losing an average of 100, then your ratio is 3 to 1, and that's good, okay? So if you've got on the above one, if you have a situation where you're winning, you know, out of every 100 trades, which is kind of the example I gave you before, if you're winning 60 of those, that's 60%. And that's pretty good, actually. Here's an interesting table, and this is out of my book, A Trader's Money Management System. And it shows here, okay, the risk of ruin probabilities with 10% of capital at risk. Okay, and basically what we're showing you is how the payoff ratio, all right, is married basically to the win ratio. You can see the different win ratios on the left-hand side as compared to the payoff ratios on the upper side. And so if you have a trading system, all right, that's winning only 50% of the time, but your payoff ratio is 2 to 1, you have a very small 0.8% chance of going bust with that kind of capital at risk. So it really brings home the fact that actually you cannot be winning or be winning just as much as you are losing and still be profitable in this business if you use risk control. A great example of this, if you go to my website, if you go to the home page at www.traderscoach.com, just type that into your browser or write it down for later, and go there. On the home page, you're going to see something that says see our results. You click on that button. I've got every trade listed for 2013 there. And that's going to, the reason I'm directing you there is because I win about 60% of the time. And currently, year to date, I'm probably about, I think I'm at like 56% or 57. I'm a little under my game here. But my payoff ratio is a good quality 2-to-1, if not a little higher. And I have that results there. Guess what we're up for this year? 1,027%. Let me repeat that, 1,027%. Why? Because we cut our losing trades so quickly. So take a look at that, and it's proof in the pudding of how important it is to have a risk control program. As a warning signal for you all out there, if your drawdown on 10 trades exceeds 12%, chances are you're using you need to tighten up your risk control. Okay, that's pretty high. Because if you're, for example, using roughly a 2% risk on each trade based off a payoff ratio of around 60%, and a win ratio of 60% and a payoff ratio of 2-to-1, then on every 10 trades, you should be down 4 trades at 2% each. That's 8%. So your chances are you're risking a little too much based on the risk of ruin tables. All right. Instead, make your goal. Let your winning trades run and cut your losing trades short, and avoid exposing yourself to unhealthy risk. Develop a systematic approach to money management. Be aware that risk of ruin is possible, and implement this awareness into your money management strategy. What we want you to do is, instead of worrying about it, we want you to make risk of ruin work for you. And you can do that. And I'm going to show you exactly how, instead of against you. We do this by determining the proper trade size, there's that word again, using risk percentage based on the risk of ruin tables, or we even have a piece of software called the Trader's Assistant that can calculate that for you. So if you don't know what the risk is based on your performance, the Trader's Assistant can help you in that category. Roughly speaking, if you're winning again 60% of the time and your payoff ratio is 2-to-1, that figure is roughly 2%. All right, I cannot emphasize this enough. This is your goal as a trader. This is your goal in risk control. Keep your losing trades small and let your winning trades run. Because some of those winning trades can be way over 100%. And if you keep those losing trades to 2%, the light bulb should go on in your head right about now. You can see what this is all about. All right, so how do you do this is the next question. Calculate your trade size for each trade. I'm going to show you how to do that. Calculate your percent to risk. All right, your percent to risk probably is just going to be very generically 2% for right now. Okay, let's do a little question here and see how we go along. Okay, let's do an exercise. All right, let's say you had a trading account where you had $50,000 funded in it. All right, you were trading with a stock margin account allowing you to margin 50%. All right, so you have $75,000 of buying power available to you. Okay, you trade using the 2% risk rule. Your trade entry on this example is 26.99. All right, so this is a stock trade, and your initial stop loss is at 25.45. Your commission in this example is $10. All right. Question: what is the maximum trade size based on this example? All right. You're probably not going to know it, so we're going to show you how to do it. First thing we want you to do, okay, and I'm going to give you information on where to get some of these tables a little later on, but if you want to copy them down, feel free to do so right now. All right. Calculate your dollar risk amount as step one. Very simple. Take the account size times the percent risk, and that's going to equal the dollar amount that you can afford to lose on any given trade. All right, so obviously 2% of 50,000 is $1,000. This has nothing to do with buying power. This is only the amount that you're allowed to lose on any given trade. All right. Then the step 2 is we actually calculate our trade size. So you take the risk amount, which is the $1,000 that we did in step 1. We want to subtract out commissions so we have a net figure. All right. And the commissions are round trip. All right. And then we want to divide that by the difference between the entry and the stop. So when you get ready to trade, there's something you're going to need to know before you take the trade. If you're going to take a trade at a certain price level, you need to know where your stop loss is, because you need that to complete this formula before taking the trade. All right? And so the answer in this question here, and I'm going to talk a little bit more about that in a minute, but the answer to this calculation is 642 shares. That's the maximum trade size. Now, if you feel comfortable trading only 200 shares, well, then that's what you do. But don't exceed 642, because if you do, then you're not putting the risk of ruin on your side. You're putting it against you. Okay, and there's the answer to our question. All right, I want to introduce to you a piece of software that we have that's really slick at doing all this. This software has all the calculations built into it. It's called the Trade Size Calculator. It can be used for stock, futures, and Forex, if you notice, okay? So it has the Forex built into it, so you can use it for pips, you can use it for futures, and you can use it for stocks. All right, very simple. You put your account size in, you set it up for your percent risk, entry and exit price, doesn't matter if it's a long or short trade, put in the point value. Now the reason why we ask you for the point value is because we need to calibrate the calculator. And so, for example, if this was an S&P E-mini example, then we'd have the calculator switch to futures, and the point value would be $50, because 1 point movement in the S&P E-mini is $50. If you had it set up for pips, we also have a schedule you can put the proper point value in, depending on the leverage contracts you're using. Okay? So it works really well, and when you hit calculate, the bottom near the bottom, it will come out with the maximum trade size. And in this example, it has 792, but it will also tell you the dollar risk is 1,000. And of course, 2% of 50,000 is $1,000. So that's why it has 1,000. Sometimes you're not going to see quite 1,000, because sometimes the shares may exceed, okay, any additional share or contract may exceed $1,000, and so you may see 985 or something. And that's because if you did one more contract or one more share, it would throw it over 1,000. All right, so let's just take a look at a market. And please note this is an e-signal chart, okay? Just so you know, we love e-signal. We've been using it a long time. You realize it was one of my original platforms, okay, going way back into the early or late 80s and early 90s, okay? It's changed quite a bit, okay, but it is a great platform. And very easy to use, and there's eSignal 11 as well. So everything is there. It's just a great program, very simple and very efficient. And on this chart here, you can see that we've got a entry price. It's kind of in a channel. So disregard, if you see triangles or anything, that's part of the applied reality trading system. And I'm not really here to discuss that. I really want to focus on money management. So if you see there's a trade entry price level at the top at $26.99, and there's a stop loss exit price at the bottom of $25.47. So if I get put in this trade at $26.99, I know my first initial stop loss is $25.45. So I need to enter this trade with the correct amount of shares, so that if I'm stopped out on a $50,000 account and I don't want to risk any more than 2%, then I know exactly what that figure is. We talked about this already. It's 642 shares, but this gives you a visual on that, okay? And there's the actual questions. Now, remember when we did this before, we did this when using a formula. Now, in this example, here's the trade size calculator with the formulas built into it. This is such a breeze to use. You never have to do anything but enter in a few numbers, hit calculate, and you know immediately. We use this for day trading. We use this for position trading anytime we take a trade. In order to learn how to use it, there's a help button that takes you to a complete set of instructions, including any downloadable material. For example, some of you that are futures traders may have a question on what the point value you'd put in for the calculator. Well, we have a PDF in there that has all the point values for the different futures markets, likewise for Forex as well. Okay, so in this example here, all right, I want to show you the difference between a $1,000 2% risk on a $50,000 account and buying power. All right, so the next question is, all right, we can lose up to 1,000 and stay within the risk of ruin tables based on a 2% risk based off your payoff ratio and win ratio taken into account. But the next question is, how much buying power is this thing going to use? All right, so let's go back to this example. All right, same one really, $50,000, well maybe a little different, $50,000 account. You're trading with a stock margin account again of 50%, borrowing 75. You trade using 2%. On this one, it's 91.49 and 90.23. Commissions on this example are 51.22. Sounds like a little bit of the older days when the full commissions were quite expensive. But the next question is, how much is the total cost of your initial trade with a 2% trade risk calculated? All right, is it 1,000, 1,500, 68.91, or 18.91? Okay, well let's figure it out. Okay, very easy. We use the trade size calculator. The first thing we want to do is calculate the number of shares, the maximum number of shares that we can buy with the information given to us. Okay, and that's easy. You should have that down by now. That's 753. And all you do is take the 753, this is basic math, multiply it by the entry price, which is 91.49. And so that now gives you 68,891.97. So we exceeded the initial capital of a $50,000 account, and now we're on margin of 18,891.97. All right, if margin makes you feel uncomfortable, then where in the calculator it asks for margin, instead of putting 150, put 100, and that means it's a cash account. And the calculator will stop or limit the trade size based on your account size at that point, not the risk. It does it automatically, and when it does that, it'll turn red in color, the trade size, to let you know that the account capped the trade size and not the risk. All right, and there's the answer, 68,891.97. All right, here's another little example. This is on the S&P E-mini, okay? So we're switching now from shares and a stock to contracts. All right, your trading account is $50,000. You were trading the S&P E-mini. Margin requirement is 3,500. Maybe different at your broker, but this is just an example. You're using your trade using the 2% rule in this example, and that 2% you arrived at through keeping careful records, so you know your win ratio and your payoff ratio, and using the formulas in the risk of ruin tables and Optimum F, you determine that your percent risk is 2. Your trade entry is 1,088.25 on the E-mini, and your initial stop is at 1,085. So it's a long trade. Your commission is $10. What's your maximum trade size in contracts? Is it 10, 6, 3, or 2? All right, here's an example of how this setup looks on a chart, so you can visualize it. I always like to visualize it. Notice the difference between the entry and the exit is $3.25. Now, let me ask a question right here, now that you're getting a little more familiar with all this stuff. What if the risk was lower? What if it was half that, like $1.50? Would that affect the trade size? You bet. All right, a entry and exit that are closer together, yielding a smaller raw risk number, will allow you to increase your trade size and yet still keep the risk at 2%. Likewise, if the risk is higher than 325, then your trade size is going to have to be lower than it would be if it was 325 to account for the additional distance between the entry and your initial stop loss level. This way, what we're saying here, basically in a nutshell, is that what remains constant in this way of calculating trade size is your risk percentage and your dollar, roughly your dollar per amount. However, what changes, the variable we solve for, is trade size. That's going to be constantly changing based on how much risk is in the trade and what you need to do in terms of control or keeping that risk at 2%. And the way we do it is through adjusting trade size. So I want to show you the formulas, which are going to be a teeny bit different for the futures market than they were for the stock market. So I want to go back to this. And again, these are the formulas that are built into the trade size calculator. So if you go to these formulas, you take the account size. Again, this step one's the same, all right? Basically, it gives you $1,000. What we do here, okay, is a little bit different in that we add the point value in the bottom of the division here. So if you look, you have the risk amount minus the commissions. That's the same as before. The difference between the entry and the stop times the point value. Now, the reason why we don't put the point value in for the stock is because the stocks has a 1, so you don't need it, okay? Anything multiplied by 1 is the original, right? So you don't need that. But on futures, since we have a point value that will fluctuate, same thing with Forex, because we have to put the point value in. And so this point value is $50 for this example, which is on the S&P E-mini, and the answer then is 6 contracts. If we use the trade size calculator with the formulas built into it, it automatically gives you that. And of course, the answer to this question, which you all are experts at now, is 6 contracts. All right, let's take one more just to hammer it home, okay? Here's an example, and again, the triangle is part of the applied reality trading system, okay, which we have available at traderscoach.com, which of course you can learn more about. But it is generating a possible entry. We're not into this market yet. If markets get above the point of the triangle, which represents a major resistance area on an uptrend, then we want to go long at 1168.25. Once we go long, if we're put long on this trade, then our immediate stop loss, initial, is 1162.25. And the risk is $5.75 on this. So when we plug all this stuff into the calculator, it's giving us a contract size of 3 contracts. It does it automatically. Here's an example of a trade where we had actually multiple entries. This was Disney. Okay, so we had to do 2 types of calculations real quick. We had to do point A and point B. Point A was our initial value that we put in, all right, and then point B was an add-on to this. So once the risk is gone, once we trail our stops up to a new level using our new pyramids, but again, it doesn't matter. It can be any trading approach you're using, all right. Once you have a stop that has moved up to a new position, we call this a trailing stop, then the trade risk, not the market risk, but the trade risk is gone from the initial entry. So you're allowed to add into the trend again. This is the only way I recommend, okay, pyramiding into a trend. In other words, adding into a trend, is only when your trade risk from the initial position, all right, has been neutralized by a new stop loss, a trailing stop that has locked in profits if you're stopped out on that initial trade. Do not, on short-term momentum trading, do not, okay, add into a trade, a losing trade, or a trade that does not have a new stop loss level in. That's called doubling down. It's a loser's game in momentum trading because you just increase your risk. So we want to make sure the risk from the first trade is gone before the trade risk is gone, before we add in. All right, so what are you going to do after you go home after today? All right, well, the idea is we want to give you some actionable steps. First immediate action is I want you to start calculating your trade size on every trade. I want you to use initial and trailing stops on every trade. Ideally, I would like your stops to be based on key market support levels. If you have some type of other alternative, all right, go ahead and base your stops on that, but stick to them, okay? Next question is, how do I do this? Well, you can use the trade size calculator, all right, you can purchase it from us. We got a webinar special. I'll give you information on that later. It's very inexpensive. It's a lot less doing it that way than doing the formulas. Or you can actually use the formulas. And I'm going to give you a link as well to these formulas again, okay? And again, I just suggest using key levels of support for stops. So that's what I want you to take home after you finish this webinar today. And you have to first, though, before you can implement any type of money management or risk control program, you have to have your mind thinking you really need risk control. And so you need to be in an area of open awareness. So you don't want to be so a fearful trader. This is not what I'm trying to do. I'm not trying to make you a fearful trader. I'm trying to make you an aware trader. And by acknowledging the good and the bad of what could happen in the markets, and by fine-tuning your money management system, you'll be really on the way to greater prosperity, and you'll be trading with a lot less stress. A lot less. Because each time you enter a trade, you have answered the question, when you use risk control, what happens if this trade doesn't work? And once you have that answered, and you have that answered in a structured way, using good, disciplined money management and risk control techniques that I've showed you here, then you can relax and concentrate on the trade itself. It will help remove those nasty little emotions that can creep into our trading that cause us all to do stupid things. All right? I always want you to use risk control. This is not investing. All right? There's folks out there that say, you don't need stops. Yes, you do. Okay? Trust me, you do. If you're not using them, eventually you'll be gone. You have to use risk control. All right, and finally, I just want to say thank you for attending, and I want to give you some links here. Let me just go. This is our contact information, of course, but you can find us on the web very easily. Now, I got a special offer for everybody attending the webinar. It's going to be for a couple days. And here's the offer. It's basically we sell the trade size calculator. This is a lifetime license, includes all the updates, blah, blah, blah. But it's roughly $249.98. We're going to make it $49.98 for everybody that attended today. So that's a good deal. There's the link at the bottom. Now, on that link at the bottom, when you click on that, not only will you have the option to buy this, but you will also, if you scroll down on that page, you will also see an area there where I have an article you can download that has a lot of these formulas that I promised I'd give you during the webinar. So I don't think I can post any links in here, but if you go ahead and go to that, I'll leave this here for quite some time so you can check this out. But go ahead and write that link down and then go into your browser and bookmark it. We're not going to have this available for very long. All right, at $49.98, I've either proven its worth or I haven't at this point. So I can't believe anybody needs a week to think about it. So it's only going to be there for a little while. So at this point here, if you're interested, you're going to want to jump on that before we remove the offer. All right, well that kind of ends this session on money management and risk control. I don't know if I can see any questions, so I don't know how that works here.
Hey,
but
Bennett.
If you have any, I'll be glad to field any. Yes.
Absolutely, you can see questions. Give me 1 second. If you look at your GoToWebinar over on the right-hand side of your screen.
Oh, okay.
There's a questions tab.
Is up there now. Got it. Okay.
Yeah, if you pull that over, you can see a whole list of questions there, and I figure you can go through and field a bunch
All
of
right,
questions
give me a
because you have quite a
second.
few.
Let me just, yeah, good. Okay, thank you. Yeah, when I first logged on, I didn't see that. Okay, I guess when you made me a presenter, I got to see that. Okay, hold on. Give me 1 second. In fact, this will be helpful because what I'll do with this is also put up a couple links here. So let me send this link for this offer here. Okay, so there's that, so everybody can access that. And then hopefully I'm doing that right. Okay, that's in the chat area. Okay. Also, too, I'm going to give you a direct link also to the money management article as well, in case people having trouble locating that. So let me give you that. And then also, I want you all to take a look at our 2013 results because it really hammers home the risk control aspect. So I put all 3 links up that are important. And again, that risk control aspect is, all right, you know, we don't win all the time. Some people will preach that their systems are 80% accurate. Well, you know, ours are too, depending on how you measure it. But over time, if you're doing 60%, you're doing good. The key is how big are your losses and wins in relation to one another. That's what's going to make it profitable or not. And that's what the results link I just put up there is going to show you, because there's every trade is listed there, both the good and the bad. Okay, but you'll notice the bad trades, okay, are not big losers. That's the key. All right, so let me see about questions here. Okay, does the trade calculator also apply to options trading? Of course, if you take an options trade, there's different ways you can apply it, but if you take an options trade, you can, 2 ways of limiting risk. Let's say you buy a call or a put. You know right away that premium you just paid, that's your risk, right? Okay, so you can structure your risk that way. Or if you want to use the underlying asset to base getting out of that option, let's say you buy a call, in the money call, and it was expensive, and it's in the money, and the market moves in your favor, all right, then of course you move the stops up on the underlying asset and so forth and so on. But when you get to originally take the trade, go to the underlying asset, calculate the trade size based on, let's say if it's IBM stock, let's say the trade size calculator says if you enter at this level, set your stop on this level on the underlying asset, then you should buy 750 shares. Well, you know that if you want to use options, just buy 750 shares worth of options, which is how many contracts? About 7, right? Maybe 7 to 8 at that point. I'd go a little conservative. And then when it's time to get out, if your system is tracking the underlying asset and it's time to get out, then you exit. If you can move your stop up, it's great. But that way you're protected. Okay, another way to use the trade size calculator for options is that sometimes premiums can be charted on a chart just like the underlying asset prices. So you can use it right on the premiums instead of for contracts. Good question. Thank you. That's the only question I see. If I'm missing any, let me know, but that's it. We got just, well, we got about a few minutes left. Okay, well, I think that's it.
Alrighty, then we'll go ahead. We'll take about a 10-minute break. I want to thank you for coming in, Bennett. We really appreciate having you. The next speaker, everyone, is going to be Dwayne Gott from eSignal. He's going to be talking about day trading with Gann levels. And again, that is going to start right at about 1 o'clock, so here in about 10 minutes.
Okay, great. Well, thank you so much. I enjoyed being here. And again, I want to appreciate everybody coming. And I appreciate eSignal and everybody involved in this, putting it together, because it is quite a big operation to do that. So thanks to everybody. All right, everybody, have a good weekend. We'll see you here next time. Bye-bye.
Hey, Dwayne, can we go ahead and do a really quick sound check just to make sure that everything is good? We can see your screen already.
Okay, good. Yeah, can you hear me?
Sounds
Testing,
good.
testing. Okay, perfect. All
All right,
right.
we'll be kicking things off here in right about 10 minutes, give people a little bit of a break, and then we'll go ahead and get started.
Sounds good. All right, thank you.
Alrighty, everybody. We'll go ahead and get started with our last presenter of the day. His name is Dwayne Gott. He's here from eSignal, and he's going to be discussing day trading with GAN levels. Dwayne, are you here?
I am here. Thank you, Thomas.
Absolutely. Go ahead, take it away.
Thank you very much. Hello and welcome, everybody. My name is Dwayne Gott. I'm one of the senior instructors for eSignal Learning. I am tied specifically to the advanced GET product of eSignal, sort of the upper echelon of what we offer in terms of our trading model. And today we're going to be talking about day trading with GAN. Now, a couple of things that I want to kind of go through as we get into the nuts and bolts of our presentation today. Last time that I was here with ValueCharts, we went through an Elliott Wave presentation. Today we're going to venture into the deep end of the pool. We are going into one of the most powerful market theories out there, but probably one of the most misunderstood, and that's GAN trading, GAN theory. And what we're going to do, hopefully through our time together today, is to go through GAN's method, and specifically we are going to be talking about the square of 9, one of the most popular aspects of GAN's trading methodology. And then finally we will have a short QA period after we get through all the material. So if you guys have questions or you want to explore this particular market theory a little bit more, I'll be able to point you in the right direction. Now, with that in mind, let's talk here a little bit about William Delbert Gann. Born in 1878, he passed away June 14th in 1955. Born just outside Lufkin, Texas. Came from pretty humble beginnings. His family was in agriculture, son of a cotton farmer, and also a deeply religious family, a very devout Baptist family. And a lot of those